Good morning, everybody. Look at me, right on time, 9 a.m. How's everyone doing today? Happy Friday. John Novak throwing some wisdom in the room. Gary, I'm not sure Abe Lincoln said that. He may have. Who knows? But I like it. How's everyone doing today? How you guys feeling? Can you hear me okay? Coming through loud and clear? Yoda outranks Abe every time, man. Every time. Cool. Happy Friday, guys. Happy Friday. Um, I'm Mark. Who's new? Do we have some new folks in here? I hope we do. I know we've got some people that are still working through being new, couple days in, starting to feel good. Yeah, Chef, you're new. Walker, good to see you back in here. Guys, let me explain a little bit how this classroom works. And I hope that that we can stick to this path today. This class is a 3-hour discussion. It's not a lecture. The people that participate the most, that show me the most pictures, that ask the most questions, these are the people that typically get to where they want to be the fastest. So I want you to embrace that. I like to think of this classroom as it's just you and me, guys, one-on-one. So there's nobody else in here except me and Dwight. And there's nobody else in here except me and PFI or me and Safia or me and Gary. And what you're doing is you're taking the information that I'm giving you and you're going to show me a lot of pictures and we're going to have a conversation about everything you're doing. And that's really how the classroom works, guys. And that's going to be your path to success. To becoming a confident trader ASAP, post your trades in class. And guys, don't just post them in class and go, was this a trade? Or don't just post them in class and go, this is, tell me what you're doing. Tell me why you're doing it. Make it a conversation. Make sure that you give me information. Why did you get in? Write your rules on the chart. Because this class isn't about me telling you what's right and wrong. This class is very much about me helping you learn to read your indicators so that you can make the decision what's right or wrong for you. So tell me why you're getting into trades. Tell me what compelled you to pull the trigger. What made you feel like that long trade was the right trade. And what we'll do is we'll go back and we'll look at your charts and we'll discuss advantages each and every time. Everything that you show me, we're going to talk about advantages. And guys, here's the part that stings a little bit. We're going to talk about disadvantages. So if somebody telling you, hey, you did this a little wrong is going to hurt your feelings, I want you to work through that a little bit because my goal is to get you where you want to be, right? And that comes from honesty and honest feedback and teaching you to recognize advantages. So post everything that you do in the classroom, guys. Everything that you see and wonder, post it in the classroom. Let's have a conversation. And then use your spreadsheet. And man, this spreadsheet is gold because this spreadsheet provided to you by Nexgen. You're going to find it in the Nexgen Study Picks folder. And I'm going to give you access to mine as well. I'm going to give you my personal one as well. But this spreadsheet is your trade journal. And your trade journal is going to let you record everything that you do. The first page, these are the trades. These are the trades that you take on Simulator. These are going to be the trades that your rules are met. You pulled the trigger on. Sorry, guys, I'm I'm in a position right now, but I wanted to start class. Time to go break even. Everything you do, you're going to put in the room. You're going to talk about what you see, why you did it, and then you're going to put it in your spreadsheet and you're going to have that same conversation with yourself. Were my rules met? What are the notes about it? What happened? Did I win? Did I lose? And every morning, you're just going to come back and study yesterday's trades. Did anybody look at what they did yesterday and go, oh man, I can do that better today? I can get in a little bit quicker. I can manage my risk a little bit better. I can pick my targets a little more intelligently because that's the goal every day, guys. The goal every day is that you're going to be able to take what you did yesterday and just turn it into a better situation today. What worked? And what you're going to find is that when you're following rules, that tends to be what works and what doesn't work. And you'll find that when you break your rules, that typically doesn't work. and the two just kind of come together, and you'll be able to repeat it. You'll be able to recognize patterns that are bringing you success, and you'll also be able to recognize the patterns that are removing success from you. And you'll recognize these patterns not only in the market, ladies and gentlemen, but also in yourself. Some of us, most of us, I would say all of us, have things that we're drawn to, whether it is breaking the rule about trading in determination conditions, or whether it is getting in a little earlier, getting out a little earlier, getting in a little late. And when you use a spreadsheet, you're going to identify that pattern and you can kind of resolve yourself every morning. Yesterday, I traded in determination conditions 3 times and I lost all 3 times. So today, I've got a giant note on a piece of paper in front of me. Mark, don't trade in determination conditions. It's taking money out of your account. So you'll be able to use this spreadsheet every morning. Go back and study it. And if you go through that simple little two-step process, post in the room, get some feedback, and then put it in the spreadsheet and tell yourself, I'm not going to make those same mistakes every day. I'm not going to break those same rules every day. And you are, because you're new. Let yourself be new, but you're going to do it less and less over time as you mature as a trader. We're going to spend the first hour, guys, talking about the trigger lines and the Fibonacci rules for when it's okay to trade. And we're not going to talk about every rule for every trade ever known to man, right? Because that's overwhelming. So we're going to focus on simplicity. And I'm going to go to the tutorial section here. And I'm going to let you know which trade we're going to talk about in the first hour. And that first trade, guys, your foundation is going to be a high probability trend trade. And a high probability trend trade is a trade where every indicator on every chart agrees for the trade. Triggers are their strongest. Nothing's in the way. No trouble spots between your entry and your target. If you were around yesterday afternoon, John Novak was taking these high probability trend trades in the live trading room. He was doing it in front of God and everybody. This is what we're doing. Here's our rules being met. This is where we anticipate the market to go based on what our indicators say. Let's get into this trade together, guys, as a class. And it was pretty cool. And if I'm not mistaken, John, how did you end up yesterday? I don't know if he's listening here. Um, I want to say he was 3 for 3 on high probability trend trades, trading the NASDAQ. So we're going to focus on this one because this high probability trend trade, guys, good morning, Jose, is going to teach you to read your charts. It's gonna make you a chart reader. And this is the what chart reading is. Good morning, Snorri. What chart reading is from an AI standpoint. Hey, what's going on, Paul? I think that I may have, but I'm trying to delete the other ones. Did if somebody is sending you stuff and they say it's me, guys, report it. Uh-oh, you got called back into work. That's all right. Get the nuggets, chef, and if you have any questions, man, you can always reach out, email me. I'll do my best to answer them. Good morning, Sydney. Guys, if you ever get somebody sending you something from Nexgen and it seems weird, don't click on links and stuff like that. There are bad people. Jose, I think I have 2 profiles, but I think one of them is just under my name when I was trying to create the Nexgen education one, and I haven't figured out how to delete it. Nope, Nexgen Mark is Mark Dean. That's Big Daddy. That's Melinda's dad. He's on the sales team. Yeah. He's the better looking version of me. He'll tell you that every chance he gets. Love Mark Dean. As you're going to be chart readers, I want you to wake up this morning and say, I'm not going to be a day trader today, I'm going to be a chart reader. Because chart reading is going to open the door for every trade that you want to take. Chart reading is going to make it where you can recognize advantages and then you can capitalize on those advantages. And when you're a chart reader, you're going to understand, and dare I say fluently, where the market is likely to continue. And you'll be able to use those continuation points for entries. Initially, you're going to use it for the high probability trend trade, and that's a trade that typically wins 70 to 80% of the time. You're going to understand where the market is likely to go. I had an email conversation with a gentleman the other day, and he's like, how do I hold for larger moves? How do I hold for larger moves? Um, and when you really get good at reading your charts, you're going to understand where the market is likely to go, and it's going to allow you to catch more profits. It's going to allow you to hold for a bigger duration. And then finally, you're going to understand where the market is likely to stop. We call these termination conditions, and these can stop the trend. Um, these can stop the trend. Termination conditions. And if you guys want to see an example of one real quick, PFI says, hey, Mark, check it out. I reached a fib and no triggers went through. That's a termination condition. It can't be a high probability trend trade, right? Because there is no clear path. Great picture. Great recognition. Um, and that's one of those likely to stop areas, guys. This is your red flag saying, don't trade into this area. It can stop the market. And that's really going to be the strength of your chart reading, because when we have a termination condition, and if it does reverse the market, and man, I'm telling you, these fibs can reverse the market all the time, that is your anchor for the highest probability trend trade that we teach. When the market reverses from one of these key Fibonacci areas, and you'll be able to understand, you'll recognize it, you'll see it way in advance, the same information that these institutional traders, these deep pocket traders are recognizing. When it turns the market, that trend trade that you're going to find after it is going to be the highest probability trade that you can take. Um, so let's keep it simple initially, right? Let's focus on the absolute best of the best. Let's build a foundation, become a chart reader, and understand, guys, that you're in a marathon right now. It's not a sprint. You're going to spend the rest of your life getting a little bit better every day. The education process is never over. Guys, I learn something every day. I have the same conversations with my brother every day that you and I have in this room. We compare pictures of charts. We look for patterns that make us comfortable, that bring us success. We look for opportunities to hold trades longer. And we are in a constant state of trying to be better at our craft. And I want you to take that same approach. Build a great foundation and become a chart reader, and then you will refine your craft. You'll find things that suit you the best. Simulate. I can't stress this enough. Get that simulator cranked up and take all the trades that you think you see. Take all the trades that you hope are going to work and get them into this room so we can talk about them. And what we're going to do is we're going to take that high probability trend trade, and that's the trade. It has three distinct advantages that are the recipe for a trade. Every picture that you put into this room, we're going to relate to these three advantages, because these three advantages are your chart reading. These three advantages are going to spread themselves across the board for any and every trade that you take. And you'll understand these three key concepts by the end of the class today. Momentum, clear path, and an entry area. That's the recipe for a trade. So you're going to simulate and you're going to practice those correct rules, embracing those advantages, and you're going to keep it simple, guys. And I can't stress this enough. The more you give yourself to think about, the less clarity that you're going to have. Keep it simple and focused, right? Focus on one trade, get good at it, and then add a second trade. Good morning. That's all right. You run as late as you want. I have not issued a tardy slip in 3 years, so you're good, Dwight. Nice to have you in here today. What looks are you going to commit to? And I like that word commit. What looks are you going to commit to? Well, the looks that I'm going to commit to are the looks that give me those three advantages, because that's my path to success. And success breeds confidence, guys, and confidence makes you an amazing trader, right? Being confident gives you that chest out bravado. Don't practice the wrong trades. Don't break rules just to see if you can get that P&L up, just to see if you can be a simulator millionaire. And we're going to simplify. We're going to look at a high probability trend trade. This is going to be your absolute best of the best, your highest chance of success, right? And then we're going to add one in it today. We're going to talk about medium probability trades. Medium probability trades mean that most of your indicators line up, however, a small issue exists. So we'll define a medium probability trade as when one of these advantages go away, but the other two are so strong and prevalent that we're willing to take a shot. And these are going to be the majority of your trades. Your ability to read charts will have you identifying that one small problem. Your ability to read charts is going to have you managing those trades assertively. Being able to take quick profits and understanding that those aren't your home run trades. Those aren't the trades that you're going to try and knock out of the park. These are going to be base hits that add up. So we're going to have two trades that we talk about mostly today. You're going to commit to them, right? You're going to commit yourself to simplicity. You're going to commit yourself to building a foundation, to becoming a chart reader, and I'm going to commit myself to helping you get there. But you have to learn the looks so they're easy. Day one, a lot of you want it to be easy. You've got to have repetition. You've got to go through these trades over and over. This is my personal spreadsheet. Um, there's my tracking, right? Mine's empty. Um, these are my favorite looks. These are the looks that I'm going to commit to. Good morning, Abdulaziz, so that they become easy. And guys, because I want you to be successful, I'm going to give you 200 and I think it's 65 pictures of client trades, trades that I've stolen right out of the room when you guys post them. And I've said these are the trades that are right for you. These are the trades that fit your plan. These are the trades that typically revolve around those three advantages, or at least that medium probability. And this is how next-gen clients are entering these trades. You can use these as a study guide. You can use these trades and analyze them yourself. Analyze each and every one of these trades over the weekend and relate everything that you see back to these three advantages, and you'll be amazed at the results. You'll begin to trust the methodology, and when you trust the methodology, guys, it gets it real easy to execute. So post, use your spreadsheet, don't be afraid of the simulator, and keep taking pictures so that it's easy, guys. Keep taking those pictures. So we're going to talk about a high probability trend trade. 3 rules. That's it. It's not 3 rules and 1,000 addendums, right? This isn't the Constitution. We're not going to ratify it over and over. We're going to keep it simple, guys. We're looking for 3 things to happen to give us 3 advantages. These 3 advantages create the trade. And your first rule creates the advantage of momentum. And I'm going to say it right now. The advantage of momentum will fix a lot of mistakes. Rule number 2 is going to give you the advantage of a clear path. Nothing between you and your target, which is a big requirement for a trade to be high probability. And then finally, rule number 3 is going to get you in at the area where the market is likely to continue. You're going to be able to pinpoint with amazing accuracy where that market is likely to continue, where that trend is most likely to continue in the direction. And that's where you're going to enter the market, where you're going to get in, and where you're going to begin to manage these trades. These 3 rules happen on 2 charts. You folks that think more is better are going to hate the 2 chart approach, but I'm telling you right now, guys, simplicity is your path to success as a brand new user. Simplicity is going to take you to the promised land. Your large chart, we're going to use the most current bar, 1 bar on a large chart. It's a slow chart. It's a broad stroke of a brush. A large chart is what the people that move the market, the people that react to these Fibonacci areas, the people that create the momentum, that create the trend, that's what they think are happening and what should be happening. So we're going to go with the large chart. We're going to embrace the large crowd. And 1 bar on 1 chart is going to define direction, momentum, and areas. All of that information comes to you from just taking a glance at 1 chart. Your first 2 of 3 rules for the high probability trend trade occur on that large chart. And by the time you get done looking at this large chart, you will have the advantage of momentum, a market that's likely to continue in the direction of the trend. You're also going to have a clear path. There won't be anything between you and your potential profit target. And what that means for you is that the large chart leads the way. The large chart, the people that move the market are going to dictate whether or not you look for an entry. And when they say that it's time to look, you're going to go to the smaller chart, a faster chart. It's a refinement chart. What happens in only 1 bar, 1 single bar on that large chart, is typically 15 to 30 bars on a smaller, faster chart. And I'll show you a picture of how that refinement process works. This 1 bar on the large chart are all of these bars on a smaller, faster chart. There's going to be a lot of fluctuations. There's going to be ups. There's going to be downs. But what you're going to see is that you'll be able to pinpoint right where the market is likely to continue through this refinement process. And rule number 3 is going to define that area. So we're going to spend the first hour today. We're going to talk about recognizing the direction of the market. We're going to make sure that it's easy to identify momentum. We're going to begin to recognize those areas that may create a bounce or stop the market. And then we're going to talk about entries. That's going to be our first hour. I'm going to encourage each and every one of you. If I go over a concept and you need a little clarity, don't be shy. Raise your hand and say, hey, Mark, can we talk about that one more time? I'm having a little trouble with momentum. Guys, if my first hour lasts 3 hours, I'm okay with that. This classroom is designed for the new user. This classroom is designed to help you build a foundation to become a chart reader. You're also going to see more experienced traders in this room. You're going to see traders taking trades that are not high probability trend trades. You're going to see traders taking trades that we call medium probability, 50-50 trades. You're going to see traders taking what we call HVA trades. You're going to see them taking momentum trades. You're even going to see some yahoos taking some counter trend trades because they've got a great plan for it. And the idea is that each and every one of these people that have built these awesome trades did it because they were able to read their charts, because they were able to understand momentum, a clear path in an entry area, and then they're looking for advantages that suit their needs, their personal style. So there are no wrong trades in my classroom, and everything that you put in this room, I'm going to relate back to these advantages. And the first advantage happens on the large chart, guys, and the first advantage says that I have to have strong triggers. And here's one of the cool things about what we do is I can't have strong triggers unless it's in the direction of the trend. And the trend is super easy to identify. The trend is on your large chart. If that background is green on a large chart, it means that I'm only looking for rules for high probability trend trades long. And then on that large chart, if the background is red, I'm only looking for rules to be met for high probability trend trade short. And guys, it really can be that simple. And by sticking to the trend, I'm going to tell you right now, you will probably eliminate 50% of the typical new user problems because you're not going to form an opinion. You're simply going to go with the flow. And let me show you how easy it is. Let me go back to my live market. Are we in an uptrend or a downtrend, ladies and gentlemen? What do you think? New users, this is a great opportunity for you to just test your skills, right? Uptrend or downtrend on the S&P right now? We're in an uptrend. How easy was that? Thank you, Dwight. Snorri, it's up, right? So let's check a different market. Uptrend or downtrend? I know, guys, it's tough to type a D or a U. Thank you so much for your participation. But you're absolutely right, guys. We're in a downtrend here in crude oil. This means that I'm only looking for rules to be met for high probability trend trade short. And I'm alleviating myself from the burden of opinion. I don't hope it goes down. I don't hope it goes up. I simply say it's going up or it's going down. Now let me get to looking for rules to see if I have a statistical advantage to take a trade. And the first rule says strong triggers. So in an uptrend on my large chart, strong triggers means that my small triggers, these two solid lines, have broken above my large triggers, these two dashed lines, and the space created between small and large, that's your strong trigger look. That's the best of the best look. This is a look, when I have strong triggers, it means that the market is likely to continue in the direction of the trend. The odds are favorable for the market to continue in the direction of the trend. And you're going to hear this in class all the time, odds favorable momentum. Hey, Dwight, did you have odds favorable momentum? Sydney, did you have odds favorable momentum? Hey, GWC, did you have odds favorable momentum? And we're going to talk about it, and this will be the first advantage that I relate to when we go back to look at your charts. The separation of the two triggers lets me know that that advantage is present. It's like scissors open, waiting to cut. In a downtrend, small's below the large are wide. Your large triggers are wide and angled in the direction of the trend, and the space between the two lets me know that the odds are favorable for the market to continue down. I want you to see on this chart, these little tails or wicks on your large chart, that's that refinement process on the smaller chart. And when you see these tails or wicks with that odds favorable momentum, guys, these are potential entries for that high probability trend trade with all of that momentum in the market. You're going to look for your opportunities from the point where those triggers separate until they return to one another. Because when they return, And when those small triggers work their way inside of the large triggers, well, we call that a weakening of the large triggers. And I'm telling you right now, guys, when you have weakened triggers, anything can happen up or down. And if anything can happen up or down, that doesn't feel nearly as warm and fuzzy as the odds are favorable for the market to continue. So embrace the idea that momentum is an outstanding advantage. And guys, there's that odds favorable momentum in a downtrend. Small triggers below the large are wide, they're angled in the direction of the trend. And look at that, there's one of those tails pulling right back to resistance, a potential opportunity for you guys to get paid at 9:26 in the morning. Here I have flat large triggers. I don't have momentum just yet. We're in a little bit of a transition, but it may work its way into it. But notice this odds favorable momentum and how far that market shot up with all that steam behind it. And then on the S&P, come on S&P, there's that odds favorable momentum coming all the way from Fibonacci, taking us all the way to Fibonacci. Where the market is likely to go, that's going to be one of your chart reading skills. So guys, give me a Y in the room if you're with me. Odds favorable momentum. This leads the way. Large chart. I'm telling you right now, guys, if you commit to this, odds favorable momentum is going to cover up some of the mistakes that we make as new users. But it doesn't happen all the time, and this is the picture that reminds you of that. Notice how the market goes from odds favorable to momentum right to those anything can happen triggers. And I annotated them ACH. And when I had those anything can happen triggers, well, that preceded a reversal in the market, right? We lost momentum. It decided to go the other way. Even without the advantage of Fibonacci, we can see that that happens. There's that odds favorable momentum in one of those tails, and sure enough, it pushes in the direction of the market. We can visually see that the momentum is going away. We can recognize that that advantage of momentum is gone, and that precedes the reversal from the high. Providing odds favorable, there's a tail. And then the market gets caught in a fight. Then the buyers and sellers start to duke it out. One side wants it to go up and one side wants it to go down. And you can see that the large are still down, but the small are up, right? Or here the background is green, but the triggers are red. That doesn't line up. That doesn't make sense. This can't be odds favorable momentum if my large aren't wide and angled in the direction of the trend. This little bit of transition, guys, this fight between buyers and sellers is one of the most dangerous spots for traders to get caught in because the people that move the market are fighting it out. It's like a schoolyard brawl, right? And if you try to walk through the middle of it, you're just going to get punched a lot from both sides. So this is where next-gen users have this amazing advantage. They know to sit on their hands, to wait for these guys to sort it out, because that odds favorable momentum is going to come back, guys. It really will. And 90% of what you do during the day is going to be reading your indicators and waiting for advantages, which means that when the advantage isn't present, when that odds favorable momentum isn't just staring you straight in the face, sit on your hands and do nothing, and it's going to make life a lot easier for you. Your second advantage when momentum is present is that termination conditions are false. Remember, termination conditions are areas that may reverse the market, areas that can create a bounce, an untradeable scenario, because what happens is those deep pockets investors react to Fibonacci. They know about these areas the same way you do, and they're sitting at them. They're waiting to take profits, they're waiting to enter, and they're literally just like in the shadows. And these lines can create a reaction that can take you, the smaller trader, out of a position. These lines can be a magenta divergence high line or a cyan divergence low line. And what divergence means in the scope of what we do, ladies and gentlemen, is divergence means there was a loss of momentum. That's all it means. If a pivot forms, the market goes up and down, and you see this pink line from the top, this magenta line from the top, there was a loss of momentum. Momentum didn't follow price. And the same is true down here at the low. If you see this pivot and this cyan line prints from it, you know that momentum wasn't following price. And what that means for us is that this line, that price where the momentum didn't follow and the market changed direction, becomes a line in the sand. And that line in the sand can stop the market dead in its tracks. So we're going to respect these divergence lines. We're also going to look for red Fibonacci resistance, blue Fibonacci support, and these yellow 1-to-1 dots, which are nothing more than fibs that print right in the moment. They're bright yellow, you can't miss them, and they'll print sporadically throughout the day based on some measurements that run in the background. And these are the areas that may reverse the market. They may create a bounce, they may be untradeable. This is the big money investor. I love it. This guy knows where those fibs are. This is Norbert. He's the guy with all the money that creates trend momentum and reacts to these areas, guys. We're going to be the Remoras. We're going to let him do his reaction, and we're just going to. So termination conditions false. Let's talk about what a termination condition is. It means that it's an area that may reverse the market, and it's based on a comparison of that area and your T3 trigger lines. The same trigger lines that give you momentum are going to let you know whether or not an area is likely to break or whether it's likely to hold. And it's a two-part process, and it's a very simple process. I don't want you to overthink it. The first thing that must happen is price reaches an area, meaning that these dynamic Renko bars, these price bars, reach that blue Fibonacci support. When they do, if all of my trigger lines remain above support, support has the potential to hold the market. It may reverse the market, which means as a Nexgen user, I'm sitting on my hands and I'm waiting for that reaction to happen so that I can determine whether or not that key area is going to reverse the market. We're going to go from a downtrend to an uptrend, and then at which point I'll begin to look for rules to be met for high probability trend trades long. Or that area is just going to break. The sellers are going to win. And if the area breaks, it means that both my small triggers and my large triggers get to the other side of support. You see it up here. Price reaches support, and look how the small and large are above. This is an area where Nexgen users have the ability to sit on their hands and wait. What's the reaction going to be? Is it going to break or is it going to hold? When both your small and your large triggers get to the other side of an area, excuse me, that's when an area is considered broken. That's when the path is clear. Once again, when there's nothing between you and your target. And what you're going to notice is that if you sit on your hands here, ultimately it breaks. You do have that odds favorable momentum, and there's one of those tails, one of those potential entries to get you into the market with all of that momentum, and it continues all the way down to Fibonacci support, where none of your triggers are breaking through, and that becomes your profit target. So you're going to be able to use this idea of chart reading, areas likely to hold and likely to break, not only for profit targets, but also making sure that you do have that advantage of a clear path. Remind you guys that 90% of what you do is simply reading your indicators. 90% of what you do is gauging those advantages to see if it's time to look for an entry. So when I'm looking at my large chart here, of course, this is spread out over a little bit of time. My first termination condition happens when price reaches resistance and absolutely no trigger lines break through. And this becomes a big red flag saying, hey, no more long trades into this area. It may create an untradeable bounce. PFI gave us a great look at that this morning happening live in the S&P. Price reached that red Fibonacci area and the triggers weren't able to break. And it doesn't mean that the market won't continue up ultimately, but it means that in the moment, there may be a bounce too big to trade, and it looks like that's what happened right there. From that resistance, it pushes all the way down to support. And when it reaches support, all I have to do is ask myself, where are the trigger lines? They remain above support. That means to me, I'm not looking for short trades, even with that red background. I just need to wait and be patient, and I'm going to see which one of these areas wins. Is it going to be resistance, or is it going to be support? Up here, we come back to resistance. We come back to that divergence line. Price reaches it. All of my trigger lines remain below. So I know without question, I'm not going long. Even with those green large triggers, even with those green small triggers, they're on the wrong side of resistance. This termination condition ultimately reverses the market. There's that large goes from green to red, and I get that separation between the large and the small. And I have one of those little tails right there, one of those potential pullbacks for an entry. Guys, a termination that creates a full reversal and gives you a rules-based entry, that's your high probability trend trade. That's the trade that typically wins 70 to 80% of the time. That's the trade that creates a statistical advantage. That's your foundational trade, guys. So terminations that create a full reversal, we're going to refer to those as a strong top, or if they come from a low, we're going to refer to those as a strong bottom. You can see here that price reaches those yellow 1-to-1s, even with all of that momentum. These yellow 1-to-1s stop it dead in its tracks. They create a bounce that would have taken any of us out of the market. And you can see that indecision fight where the buyers and sellers are trying to figure out who's going to win at this key area. Ultimately, this termination creates a full reversal. Large triggers go from red to green. Small triggers get above the large triggers. And now I have what's called a strong bottom. But until my smalls and large get above resistance, this area might just create another push to the downside. So we let the triggers clear. The smalls are outside of the large, and there's your highest probability entry. There's that tail on the large chart that is a potential pullback on that smaller, faster chart. So guys, I'm going to ask you, is everybody cool? It's a simple recipe. Everybody's comfortable with it. Price reaches an area. If no triggers break through, no trade. Sit on your hands, right? Be patient. Just hang out for a minute. And I'm going to show you a picture that really breaks it into the most simple terms, guys. If price reaches, and this looked exactly like, not exactly, but very similar to the one PFI posted, none of the triggers broke through. It might still go up, but we just don't know what the reaction's going to be. But when the small and the large break through, there's that odds favorable momentum and that tail. And guys, I'm going to tell you right now, when price reaches an area, it's important to sit on your hands. You'll have an idea that an area may break if you see a scenario like this, where the small triggers really start to smash through with that odds favorable momentum. Strong triggers break areas. Strong triggers get to the next area. So no triggers, area's not broken, no clear path. If the smalls break through, this area does have the potential to break with all that momentum, but because small and large are not to the other side, it's not broken yet. Do you see how 50% of your triggers are through, but 50% are not? Guess what we call this look? 50-50, for that very reason. Has nothing to do with your odds of winning or losing if you enter a trade here. It means that 50% of your triggers made it through and 50 didn't. This area has the potential to break. Guys, this is going to be your first medium probability trade. And your first medium probability trade is absent of a clear path. So as a brand new user, focus on the simplicity. It's either broken or it's not, and understand that your ability to read a chart is going to take you to a point where you'll trade areas with the potential to break. So there's our termination conditions, right? None are there. We have a clear path. We are banking on the momentum of the market to carry us to that next key area. So our large chart has done its job. It has defined direction, it has defined momentum, and it's defined the areas. And guys, all of this happens on just one bar. It's that broad stroke. So now it's time to refine it. Now it's time to turn our attention to a smaller, faster chart. And we are going to use a limit order, meaning that you're literally going to wait for the market to come to you. We don't chase trades, guys. We don't enter impulsively. You're going to have an order waiting for the market to come back to you. And rule number 3 says that we're going to use that limit order to buy or sell a retracement, this tiny little push against the trend. A retracement is a small fluctuation in price, counter to the underlying trend. So if everything says up, your retracement's coming down. And if everything says down, your retracement's coming up. We're going to pinpoint where the market is likely to continue using that retracement, and we are going to buy or sell an area inside of favorable large triggers. And guys, this is going to be your key for the first 20 days with Nexgen. For the first couple weeks, your first 20 hours of simulator, whatever you want to call it, focus on finding these entries. Focus on getting into the market at the absolute best of the best spot. Getting into the market at an area inside of favorable large triggers. And here's your definition of favorable large triggers. Your small or your large triggers, these smooth dashed lines, These are your 5-1 chart large triggers. And these synthetic triggers, these stepped lines, they look like they have corners. Those are actually your large chart large triggers, and we've superimposed them onto the smaller, faster chart because when they work together, when they're one on top of the other, when they are wide and angled in the direction of the trend, this is going to create what we call as the smallest window of opportunity, the best of the best area for the market to continue for that high probability trend trade. And you guys are going to wait for the market right there with a limit order so that you can take advantage of the momentum, so you can take advantage of the clear path. So how do we do it? You ready? Let's go through it, and then we'll find an example in the market as well. I'm going to go to our entry section, and when everything says up on your large chart, when the path is clear, the momentum is strongest, everything is screaming to the upside, this is going to be the look on your smaller, faster chart. You should have strong triggers. You should have synthetics and large that are wide, that are angled in the direction of the trend. You've made the decision that it's time to take a trade because those advantages are present on the large chart. Rule number 3 says that we're going to buy or sell a pullback to an area inside of favorable large triggers. So before the pullback happens, we can identify what are the areas on this chart. Trend trades come from lines, guys. We enter at lines or a tick or two above or below lines, and those lines are going to be fibs, mid bands, and one-to-ones. If you're looking for a long trade, your mid band is going to be green because anytime price trades above the mid band is green. And if you're looking for a short trade, that mid band is going to be magenta because anytime price trades below the mid band is going to be magenta. So we're looking at the strength, we're looking at the favorable large triggers, we've identified our areas, and now we just need to wait for a pullback. That little retracement in price that fights trend, that little retracement in price that goes against everything the market says it's most likely to do. And that reversal bar on your small, faster chart signals the beginning of a pullback. And at the time of this reversal bar, all you have to do is find your favorable large triggers and look from the top of your large triggers to the bottom of your large triggers. That's going to be the range where you're going to look for areas because your areas need to be inside. They're large and synthetic should have swallowed those areas, fibs, mid-bands, yellow one-to-ones. This creates your window of opportunity. In a long trade, it's the highest point of support to the lowest point of support inside of favorable large triggers. Guys, we're going to activate a limit order at the top of our window for a long trade, at the highest point of that window, because the momentum on the large chart is overwhelming and there's nothing in the way for it to bounce off of. So we're not going to risk it from the bottom. We're going to look for it at the top. Your limit order goes right there, a tick or two above the mid band. And at this point, you are out of control, guys. There is nothing for you to do. Any amount of wishing, hoping, candle lighting, rosary bead rubbing, it's not going to help. It's just out of your hands. It's either going to push back to that highest point of support inside of favorable large triggers, and if it does, congratulations. You are in a high probability trend trade. You are in a trade that has the advantage of momentum. You're in a trade that has the advantage of a clear path. And you're in a trade that now has an entry area coming from the point where the market is most likely to continue. Guys, this high probability trend trade is a trend trade that typically wins 70 to 80% of the time. To recognize your window of opportunity, guys, you're looking inside of favorable large triggers. You know that that's where the areas have to be, but it's not that whole range. It's from your highest point of support to your lowest point of support. So this white box is where the market is likely to continue. And because of the momentum, because of everything screaming up, this is your entry, guys, right here at the top of the box. But I want you to be okay with the idea that it may go to the bottom of the box, that you may have to look at red numbers on your chart. Uh-oh. Discord kicked me out. I'll be right back. I know you can still hear me. I'm getting there. Every now and then, Discord reminds me who's boss. Got it coming up. Here I go. Let me get everything back in. Can you guys hear me? Yes? Okay. Sorry, they just bumped me real quick. They want to let me know. You guys see the picture again? We entered at the top, it may go to the bottom. Everybody's good with that, right? It's okay to watch a trade pull against you a little bit. It's okay to see a couple negative ticks, guys. That's normal. Totally normal. And remember that you're taking a trade here, and this is where the trust of repetition comes in. You're taking a trade, I do that every time, that typically wins 70 to 80% of the time, which means that you're taking a trade that has the potential to lose 20 to 30% of the time. Guys, small losses are a normal part of a positive equity curve. That's one of my favorite phrases for day traders. Small losses are going to happen. You're not going to avoid losses. Gary showed us a picture of his P&L yesterday, I think. He was up $1,900, and if you look at his sheet, he lost over $800 on his way to that successful day. It's just a part of it. It's a part of being a day trader, guys. So you have to be ready and willing to lose a trade. Because if you take 100 of these trades, you're going to lose. But one of the great things about the advantage of Fibonacci, one of the great things about a methodology that has been proven to win more than it loses, is we know where the market shouldn't go. It shouldn't go beyond that window of opportunity. And this is why you focusing on entries for your first 20 days is the most of yourself. Because if we know that the market shouldn't go beyond these large triggers, beyond the areas inside, we can have a protective stop. We can gracefully take that 20 to 30%. We can allow the market to be wrong, and we can manage our risk, guys. I see new users putting stops $300, $400, $500 worth of risk away. That's just not necessary. We know where it's supposed to bounce. We have a methodology that's been proven over decades. There's a methodology that is repeatable that you can study. And this is where our stop goes. And guys, this is a trade that I will take 1,000 out of 1,000 times. Because 70 to 80% of the time, where's my internet? There it is. Because 70 to 80% of the time, this is what we're looking at. We're looking at profit target reach, that momentum, that clear path, carrying us to the next Fibonacci area. Once the market begins to move in the direction of my trade, I'm going to reduce my risk below that reversal bar going in the direction of the trade. Guys, I'm going to manage my risk before I ever manage my profits. And this is your look, guys. This is your high probability trend trade. This is the trade that I want you to study. I want you to focus on those great entries, getting in at the best of the best area. And what you're going to see is that when you have odds favorable momentum, when that market hasn't reached the next area yet, there's that tail. And that tail is not what we're trading. That tail is not our entry. That tail is a reflection of the pullback to areas inside of favorable large triggers on a smaller, faster chart. But you can study this look, you can verify and validate, and you can become comfortable with and trust this look by opening up a larger chart, right? This is the S&P. And I'm just going to circle this one. Let's see what it looked like. Everything says down, the triggers are through the areas, the smalls are below the large. What's it look like on a smaller, faster chart here? It looks exactly like a pullback to resistance inside of favorable large triggers. And this, ladies and gentlemen, becomes an opportunity for you to make money. And notice how with those smalls outside of the large, it went to the next key Fibonacci area. So this particular trade, if you took it at 52.25, it didn't stop until 44.25, guys. That's 8 points in the S&P. That's $400 worth of profit per contract. That's a pretty good start to your day. Sometimes you're going to get it directly into that area, right? And you're going to see that odds favorable, and you're going to see the market continue through. And one of the other things about trading rules and trading statistical advantages is that if the path isn't clear, it's okay to say, this isn't my money, this isn't my trade, this isn't for me. I'm going to wait for the path to clear. And that's one of the hardest things for new users to do, is to do absolutely nothing when there's nothing to do. Look at this momentum, guys, and we're coming from that termination condition. There's that tail. And there's that pullback to resistance, right? And it's right there at favorable large triggers. But guys, not every trade is going to be perfect. And this one has the only termination condition that I consider on a smaller, faster chart. And I'll share that with you. 46, 44, 65, 50. So cream white, you should always have a black highlighted in the gray area. That lets you know that you're on the most current bar. If you ever see your chart and you're like, I don't see that, this white arrow will get you to it. Are we trading in the same spot? I just want to make sure that your chart is where it should be. Yep, okay, cool. Guys, are there any questions about the high probability trend trade? If you're brand new, you're drinking from a fire hose right now, ladies and gentlemen, and I fully understand that, which is why we teach in a foundational approach. I want you to think of day trading as eating an elephant. I'm sure a lot of you have heard that old analogy. How do you eat an elephant, right? One bite at a time. You eat an elephant one bite at a time because if you say to yourself, I'm going to eat an elephant, it becomes overwhelming. If you say, I'm going to eat all 1,000 pounds of that giant beast, it's overwhelming, guys. But if you say, I'm going to do this one bite at a time, anybody can manage that one bite. And it's the same thing. I know we're all getting a little older. If any of you have ever been on a weight loss journey and you said to yourself, I'm going to lose 20 pounds, I'm going to lose 30 pounds, I'm going to lose 40 pounds, eat that frog, I'm going to have to look that up. I was a personal trainer for years and I had clients telling me, I'd say, what's your goal? They say, I want to lose 50 pounds. Guys, losing 50 pounds is overwhelming. It takes a long time to put it on. It takes a long time to take it off. But if you change your mindset, I'm going to lose 1 pound a week over the next year. Guys, you're down 52 pounds at the end of the year. You're exactly where you wanted to be, but you gave yourself a little bit of grace, understanding that these great things don't happen overnight. So when you guys eat the elephant that is day trading, the first thing you're going to do is just recognize trend, right? Is it going up or down? Is there anyone in this room that isn't already comfortable with if the background is green, we're going up, and if it's red, we're going down? Because you learn that first skill in a matter of minutes. And then once you have it, you add the second bite. And the second bite is making sure that you understand odds favorable momentum, that separation between the triggers creates the first advantage in looking for a trade. And then when you're good with that, when you can identify that odds favorable momentum, well, then you may spend a little more time working on your termination conditions. You may need to scroll back and look at the reaction to Fibonacci, and remind yourself the recipe, price reaches an area. And if none of the triggers are through, I just need to sit on my hands. And then this is going to become second nature for you. You're going to be able to go to your chart and say, hey, price reached Fibonacci and none of the triggers go through. I need to stop for a second. I need to sit on my hands. But if you do have that clear path, your fourth bite becomes the entry, that area inside of favorable large triggers. And if you allow yourself to be laser focused, singularly focused on this high probability trend trade, your chart reading is going to take you to just next levels, guys. Don't give yourself the burden of too many choices. Don't give yourself the burden of too many rules. Let simplicity lead everything that you do as you learn the software. And I can tell you right now from experience, my most successful traders that I see posting trades, whether it's in this room or the other room, the most successful traders that I know have one, maybe two trades. They have a very distinct set of rules for entry, and they are committed 100%. Either my rules are met or they are not. So as a brand new user, here's a wonderful set of rules to define your entry. This is what we call the high probability trend trade checklist, guys. This is reminding you of the three advantages that need to be in place. This is something that you can print out and put on your desktop. Print out 10 copies, and every time you take a trade, you should be able to check yes. Is there a termination condition creating the full reversal? If it is, I know this is that 70 to 80% winner, right? I need to look for that first. And if it's a yes, I'm going to guarantee that I have odds favorable momentum. And I'm going to make sure that there's nothing in the way, and there's got to be an area inside of favorable large triggers. And I have never in the history of this checklist had anyone do worse than 70% winners, ever. I've had people backtest this over a year with automated simulation. I've had people backtest this over 300, 400, 500 days, 1,000 trades. And most of them end up in the 85% range, guys, but we're human and we're going to make mistakes. This is your simple plan. This is the one that gets you into the market at the absolute best of the best spot. And for those of you that are visual, here is the exact same checklist. All you have to do is click on these in the room and download them, or you can click and drag them over to your computer desktop. Here's the exact same looks, the exact same rules, right? What is it coming from a good top or bottom? Here it is defined in pictures. Do I have odds favorable momentum? Well, there it is. There's the description letting you know about the advantage. And just to help keep you safe, there's that anything can happen look, reminding you that your advantage has gone away. Do I have a termination condition or is my path clear? There's a picture. And guys, this is the best one. This is your window of opportunity. And this walks you from the reversal bar to the area inside of favorable large triggers. It reminds you where your order belongs, and it reminds you where your order does not belong. Guys, this visual, look at it every morning before you start. Commit to this look. Commit to the absolute best of the best. Give yourself the highest chance of success as a new user because confidence comes from the memory of success. Look at that termination condition and look at the reaction. Holy smokes. You knew that could happen and you didn't go long. And since you didn't go long, you didn't lose your money. The next gift is Friday's all about gifts. Guys, here's a plan for success. Here's a plan for consistency for the brand new user. If you are in your first week, this plan is designed to give you the best chance of success for a high probability trend trade, as well as that first medium probability trade where the areas have the potential to break. This isn't designed to be your end all be all. It certainly could be. But it's designed to be a stepping stone in your learning journey, guys. It's designed to optimize your chances of success with that high probability trend trade or the 50-50 trade as a new user. But through simulation, study, class feedback, and continuous practice, you're going to craft a plan tailored to your personal goals based on your experience reading the indicators. And that's what you're going to see in this room a lot. I have users in here that aren't taking high probability trend trades. What they're doing is they're applying their chart reading that they learned from the high probability trend trade and turning it into a plan that suits their personal goals. I love it when that happens because it means that you went through the study process, you went through the foundational building process, and now you're taking trades that make you feel warm and fuzzy every time you pull the trigger. So here's your simple plan of consistency, guys. It's not designed to hold you back, it's designed to keep you focused. Never fight large chart direction or triggers. Never fight large chart direction. Don't trade against the trend. It's going to eliminate a lot of losers. Don't fight against momentum, guys. Momentum wins more than it loses. It's like running head first on the highway against traffic. You're probably not going to come out of it looking pretty. And all you're doing is defining your entry, guys. 20 days of perfect entries because great entries create manageable trades. Here's the rules. There's that checklist that I gave you. Get in the habit of writing these rules on your chart. Every time you take a trade, write the rules on the chart. Here's my odds favorable momentum and here's an arrow pointing at it. What you're doing is you are associating your rules with a visual look. You're making the two mesh together and you're creating your brain. Your brain is saying to itself, this is my rule and this is my look, and if I don't see this, it's not my trade. Here's your clear path. There's your arrow. This is my rule and this is my look, and if I don't see it, it's not my trade. And then writing the rules for the entry, reminding yourself that it's a pullback to an area inside of favorable large triggers. This is my rule. This is what it looks like, and if this isn't happening, this isn't my trade. And it's okay for it not to be your trade, guys, because if you put yourself in a position where it's either rules met or rules not met, you know that every time you enter the market, you have a statistical advantage. And this is where trading gets fun. Guys, most of you are going to start finding entries in the first week. Most of you are going to start nailing these rules within the first 10 to 15 days because they are simple. They just take a little bit of study, they take a little bit of repetition, and it takes a little bit of commitment to try not to breach outside of them. You're going to because you're human, and I like you because you're human. But every great entry, every outstanding entry at an area inside of favorable large triggers, needs to be managed. It creates an opportunity for wealth and it also creates an opportunity for loss. So we're going to manage the losses as we look for the wealth. Your initial stop goes outside of the window of opportunity where the market shouldn't go, guys. And this is your picture. You take the perfect entry right at the mid band, right inside of large triggers, and your stop is hanging out where the market shouldn't go. It's typically 12 to 14 ticks. And you are 100% okay with that stop being hit if that's what happens because you know that it's a cost of doing business, because you know that small losses are a normal part of a positive equity curve, and because you know that anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30. So you build this trust in the methodology and you're cool with that. Hit my stop if you have to, but you have to come get me where you shouldn't go. So you either get stopped out, right, and it's going to happen, or you get a reversal bar in the direction of the trend. If then, let that be your plan. Let it be pragmatic. Let it be mechanical. Let it be emotionless and without opinion. If I get a reversal bar, then my stop is 2 ticks above it. It's easy to follow. It's easy to do. And now you've reduced your risk even further because the market's doing everything that it said that it was going to do. And at this point, you either get stopped out for a small loss or your first target gets hit. And your first target is $100, a measly $100, right? A nice steak and a glass of wine. But that $100 isn't designed to make you rich. That $100 is designed to make you confident because confident comes from the memory of success. And when you hear Ninja Trader tell you profit target hit, you are successful. You feel great. There's a dopamine kick. There's a serotonin rush, right? Life is amazing and they can't take that away from you. And you're going to move your stop to break even. Not only did you get paid, but now you've got nothing to lose. And nothing to lose is going to get hit a lot for the new user. You're going to have a lot of $100 trades as a new user. I'm not going to lie to you. That's going to happen. That's okay. But what that $100 and that stop does is it creates the confidence to hold for that next contract. It creates trust in what the large chart is telling you. With nothing to lose and money in the bank, you're more likely to let it reach that second target. And if it does, you just took $300 out of the market, typically in about a minute. That $300 trade is your result of a high probability trend trade with a 100% mechanical entry and a 100% mechanical exit, guys. And $300 a day is $1,500 a week. That's $6,000 a month. That's $72,000 a year in your pocket from taking the highest probability trade with the absolute most mechanical approach to management. All of this is designed, and it's right here for you in this KISS trading plan. You don't have to follow it. Guys, it doesn't matter to me if you follow it, right? I'm not paying your bills. But I can tell you from experience, and I think a lot of people in this room will echo it, that simplicity is a wonderful thing. That simplicity allows you to relinquish the burden of hope, of anxiety, of wishing, of wanting. So um, that's your first 30 days, guys. And then you can work yourself into that medium probability. And Paul, where the market shouldn't go. It's always my consistent example. But let's do this, guys. This is what we're going to do in the second hour. I'm going to start with Paul's just because it's brand new. Paul's in a short trade. And Paul says, I'm going to get in at the area inside of favorable large triggers because everything says down. And you notice that he doesn't have odds favorable momentum. And you notice that he's not even in a downtrend, right? So he knows that he's taken a little bit of a chance based on patterns, based on the idea that if it's not a termination that creates a full reversal, that mid-band becomes a wonderful bounce point. So here's your first entry. So you went, let me look at the conditions over here. So Paul, you went short. I like the look. I like the entry. Um, yeah, it just went higher. So there's two ways to look at it, Paul. Your area where the market shouldn't go is 3 or 4 ticks behind this, right? And that's it. You weren't willing to risk more than 12, but the look was good. The path was clear. The entry was perfect. Does that make sense? Gary, there is no should have been because this is Paul's trade, right? Paul's exit is exactly where Paul wants it. There is no should have, there is no right or wrong. It's just Paul's. So, Paul, I like it. I like your entry. I like the conditions. The rules are met 100%. Your stop, I don't know that I would put it right at 1-to-1s, right? Because if it overruns this by that much, isn't that where it's probably going? Does that make sense? If it overruns your window of opportunity that much outside of where it should continue, it's probably going to hit that next key area. So if your stop's at the next key area, you're just taking a bigger loss. But if your stop is 4, 5, 6 ticks above where it should bounce, minimize those losses, and then you just take that second chance where all your triggers agree and it snaps back and it gives you an opportunity to take some cash on the way down from 53 to 43. There's $100. And you're saying, you know what? If this breaks, there's my next target, but I'm not willing to lose into the fib. Does that make sense? Managing the risk, guys. It's the perfect look. It's 100% rules based. Everything about this trade is beautiful. And this is where the market was wrong, right? The market should have continued from here, but it chose to go up to here. You could either have exasperated risk behind everything, behind the mid band, but where's it going to stop, right? Or you take that little risk from the perfect entry, lose 5 or 6 ticks per contract, and be willing to re-enter if the market changes. Does that make sense? Does that help a little bit, I hope? I know that you're not willing to risk 12, but your 12 is right at a bounce point. That's the one thing that gets me on there, is that your stop is right at a bounce point. So with everything saying down, if this doesn't hold it, that's likely to. Yeah. So then this is where you have to make the decision. Am I willing to risk? You were in where? I can't see your entry price. 65? Are you willing to put $200 worth of risk on a trade? Ooh. Oh, you were in at 86.53, which means that you had to have over $300 worth of risk up here. Woohoo, that's a lot. I probably wouldn't risk that much on a trade, not with a fib right here. That gets a little silly. Oh, you're in 65 up here. Yeah, that's your 53. And then there you've got your risk clearly defined. So it goes down to your personal preferences, right? Are you willing to put $250 per contract on a trade? Or is it better to take a little hickey and look for a reentry? That's the questions that you guys are going to answer for yourself over time through repetition. I can't tell you where to put your stop. I can't tell you how to do it, but what I can tell you is that this is your window of opportunity, and there's a small loss, because what if the market continues all the way up, right? That huge loss, oh, that's painful. But a small loss is manageable, and you would have gotten it all back down here. So I'm a big fan of small losses, but my small losses, my stops have to be where the market shouldn't go. So great picture, great questions. Um, And then one more thing, guys, as you build a plan outside of that high probability, as you build a plan outside of that medium probability, I'm giving you one more thing. This is a template for you guys looking to build plans. And it all begins with defining your entry. So often people are like, well, how do I do this? How do I do this? Mark, how do I take this trade that Nexgen doesn't teach? You create a plan, right? I've given you the plan for simplicity, for consistency. I've given you the plan for the highest advantage trades. Now, if you want to deviate from that plan, I embrace it 100%. But write down what it's going to take to get you in. And then here's the most important part that's skipped by users. Take at least 10 pictures. I say take 30, 40, 50 of your perfect entry. Go back and market replay. Scroll back. Take pictures of your rules being met so you can burn that image in your mind so that it becomes easy. For new users, for new traders, guys, one of the biggest challenges I see is that instead of simplicity, they start chasing everything, right? Instead of just looking for the best of the best, they start chasing every trade that they see in the room. They start chasing trades that people with 20, 30 years experience are taking. And they think that because they bought software, because they sat in the class, or maybe because they're good at the high probability trend trade, that they're entitled to be just as good as these people that are light years ahead of them. So if you're deviating from simplicity, guys, you need to formulate a plan. And then here's the best part about this classroom is if you tell me what it is that you're doing, if you tell me your rules, I'll hold you accountable. And I'm going to tell you right now, and some of you will back me on this, it's going to piss you off when I hold you accountable to your rules. Because if you show me a chart that breaks your rules because of things that went on in your head that you're not expressing, I just have to hold you accountable to your rules. And that's, I really think, the magic of what we do here is giving you the opportunity to be consistent, giving you the opportunity to win more than you lose, and giving you the opportunity to be in a position where everything you do has advantages. So that's our first hour. Welcome to Nexgen. It's the same first hour every day. If you're a brand new user in here, I'm looking to see who I have. G-Piece85, that looks like a new name. Um, who else? I know I've got some of my newer people, right? Wander, I believe that's a new name. Um, Great to have you guys. This is your classroom. If I said anything that's not clear, I want you to ask, right? And what you're going to find is that the people that post the most make the most. The people that ask the most questions get to where they want to be. And Wander, I see that you're on the lease. You've already committed to the software, right? You are ready. You have bought the equipment. Let's learn to use it, right? You have the best hammer in the world. Let's teach you how to build a house. Let's teach you how to be a chart reader. And I'm excited, guys. I get excited about new users. And I encourage you, let it be simple. Let it be easy. Focus on the best of the best, and you will get anywhere you want to be. Anywhere you want to be through chart reading. So, guys, I'm going to take 5 minutes. I'm going to relax. I'm going to go take my morning vitamins and stretch my legs. Get up, walk a lap, guys. Stretch your legs. Don't be glued to your computer for 7 or 8 hours. It's going to drive you absolutely nuts. So, everybody, go walk. We'll meet back here in 5 minutes. If you have a picture or a question, post it in the room. Um, Chef, it is. So as soon as we're done, John Novak will post it. Let me show everybody where that is. If you go to the Nexgen YouTube channel, under live, every time I finish a classroom, unless there's some sort of technical difficulties or something like that, you're going to be able to find it right here. And guys, what you're going to find, all of these videos, the first hour is the same. All of these videos stress rules for the first hour. All of these videos talk about the 3 advantages for the first hour. So you could click on any one of these. But the cool thing is the second and third hours are me talking about what you're doing. We're talking about what the live market is showing us. So the second and third hours are always different. And they're always different because of your amazing questions, because of your amazing pictures. So there is a wealth of knowledge coming out of this classroom every day, and you guys set the tone. So set the tone for me. Keep posting your pictures. When I come back in 5 minutes, I'm going to start clicking through them. Back in a few, guys. I love, oh man, I left the wrong thing up. You guys didn't get to watch the market. That's my bad. I love that you guys are taking the same trades, PFI. I just noticed that. That means you guys are taking that foundation and applying it into a plan for yourself. So great job. And we'll look at them too. But guys, when I go through your pictures, I have to scroll up through the chat box. Hopefully everybody can see this. I have to go through the chat box. I have to get up to the top of the day. And then what we'll do is from that, I will look at your pictures, I'll click on them, we'll talk about them, and then I'll scroll back down to the bottom of the screen. And if there was a comment or a question, I'll try to address everything that you have, and we'll talk about it. And it's pretty cool because Joel got us started today, and man, I think this is the best way to start the feedback process, guys. Joel took a beautiful high probability trend trade. He took a trade that has odds favorable momentum. He took a trade that has a clear path. He took a trade right from an area inside of favorable large triggers. Joel, you took the perfect trade. And guys, a lot of times you're going to post these trades, you're going to take these trades, and if you don't post them, you're going to have this moment where you're like, oh, it lost. What did I screw up? What did I do wrong? Where am I screwing up this process? Ugh, I'm never going to get it. But what Joel does is Joel takes a checklist and he goes, man, the advantages are in place. This is a trade that wins more than it loses. I'm okay with this loss. And if you weren't okay with the loss, by posting in the room, I'm telling you, Joel, it was a beautiful trade. It just didn't work out. And that's normal, guys. And then this one does everything it's supposed to do. And you get paid. Odds favorable, clear path. Look at the pullback to the area inside of favorable large triggers. Absolutely amazing. And then we can make money go both ways, guys. Odds favorable, clear path, pull back to resistance inside of favorable large triggers. And sure enough, down it goes. And once again, the checklist for the win. And then one more just to illustrate. When everything says up and its absolute best, there's that great entry. Stop keeps you safe and off to the profit target. So Joel, fantastic trading, great consistency, and I think it's outstanding that there was a loser in there. I never want you guys to lose, but I think it's important for you to accept and understand that losing is a part of trading. Guys, here's that odds favorable momentum. The large triggers aren't through, so the path isn't clear yet. No divergence, strong triggers. There's the entry. And then got the fib update right at the bottom and took profits when the fib updated. I saw that blue line. This was the only trade I took this morning, guys. I'm over halfway to my goal on a 2 lot. Pretty good. I trade the exact same thing I teach, by the way. I trade the same plan. I trade high probability trend trades. I trade that medium probability 50-50. And every now and then I'll take what's called a high volume area trade. And then here's Safia coming through. Safia's gone through the process, guys. She has gone through, probably posted as many, if not more, pictures than the average person that comes through this room, has asked for feedback repeatedly and has refined her plan. And she is absolutely crushing it. She's defined her entry. Safia, that is so beautiful, everything you look for. She knows where to take profits, and she knows when to get back in because of momentum to look for the next move. And Safia, that is stunning trading. Chart reading at its absolute best. And then the exact same thing. Everything says up, everything is strong, and she has a plan that lets her take advantage of all that momentum without those high probability trend trade rules. She uses her chart reading to develop a plan that suits her needs. I love it. And Safia, the consistency is beautiful, and your exits make me giddy because I know that that was something that you were working on. Absolutely fantastic. Not a high probability trend trade, but it doesn't have to be a great trade, right? Very nice, Safia. And then Sydney. Triggers up, clear path. I think maybe this was your entry here. And then you got out at the fib, at Fibonacci resistance. Sydney, great job. The only thing that I have to say, because it's a teaching class, is that the momentum isn't strong, guys. So let's do a quick lesson on the best of the best momentum. Sydney, are you with me? Take care. Enjoy your weekend. So I just want to do a quick lesson on odds favorable momentum. So Sydney, that's odds favorable momentum. Everybody in the room, that separation, I want you to think of scissors. Scissors open and they have the ability to cut. When scissors close, they lose their ability to cut, right? You can still stab somebody, but it's this right here that's your absolute best of the best look. So just for the sake of honesty and advertising, right? The momentum isn't strong. The momentum's a little anything can happen, and that's okay. All you're doing is you're saying, well, you know what? Whoops. This isn't the best of the best, but these are going to be pretty good, right? Your clear path was beautiful. In your entry area, you used a mid-band, right? You came from an area. So without the strongest momentum, when you still have the clear path at an entry point, there's still a potential trade there. And Sydney, you killed it. You traded with the trend. You traded with the direction of the trigger lines. You traded from an area. And you have a beautiful exit right at Fibonacci resistance. Nicely done, Sydney. And you're getting better at marking up your charts. Then scrolling through, Gary is next. And again, guys, your trades may not be my trades. So Gary, your first trade is a long from below everything, just trying to take advantage of a trend that's been cranking up, and you do it nicely. And what an intelligent exit, recognizing that that's your problem spot. So guys, not at all a high probability trend trade, but I think that this is really good. You're shaking with your drag and drop. Drag and drop for taking the picture. Your picture looked perfect to me. You got everything that we needed to see in there. Nicely done. So Gary takes a little bit of a, hey, let's see if we can get the last of this move. Very nice. And then he takes a very intelligent exit, using his chart reading to understand where the market may stop. And then Gary, I'm not sure what gets you into this short. That short doesn't make sense to me. I'd love to see rules for it. Market flow signals don't mean anything without rules being met, in my opinion. But my opinion is exactly what you pay for it. It means nothing. Because otherwise you would have gone long, short, short, long, short, long, short, long, short, right? So having a reason goes a long way, guys. And this is why if you write your rules on the chart, it's easier for me to give you feedback if you want feedback. If you don't want feedback, you don't have to post it in the room, because my job is to give feedback. So make it easy for me, guys. If you're taking trades, let me know why. Termination condition, no trade. I like it. Recognizing that the market reached an area, no triggers broke through. PFI said, you know what, Gary, good job. I saw the same termination condition. My rules for termination conditions are the exact same. Solid work. And then Dwight came in, and Dwight said, strong triggers, but near one-to-ones with divergence above. So Dwight, am I reading this right? You're saying price reached an area, the triggers are below, that's a termination condition? Why not just write termination condition? You're going to cramp your fingers. Just kidding. I think that's awesome. That's a great read. And let me show you the magic word. You ready? So check this out. Strong triggers. Small's outside. I like it. And this is what I get. But one-to-ones. So what you've done is you said these are strong, but it's a termination, which I think is great because what it does, Dwight, and you may not have even known that you were doing this, what you're doing is you're talking yourself through the process of looking for a trade. And guys, if I ever suggest that you were thinking something that you're not, please feel free to correct me. You opened your charts and you said, I'm in an uptrend. And then you looked at your trigger lines because that's rule number one, and you said, well, they're outside of the large, and that's amazing. And then you said, dag nabbit, this could stop the market in its tracks. You went straight to rule number two, and I love that that's where your analysis stops. Dwight, I don't know if you understand just how outstanding this chart is and how outstanding this annotation is, because what it does is it shows that you're going through that mental process of what it takes to create a trade. And when it wasn't satisfied, you said, I'm going to do nothing. These are the pictures that make me proud, guys. All of your pictures excite me. But these are the pictures that really make me go, man, you're taking those lessons, you're keeping it simple, and from that simplicity, you're going to grow. Gary, it's not a good top or a termination. I feel like, and guys, I feel is one of the worst phrases. But if I'm looking at the large chart, Gary, and price reaches a divergence high, and all of the trigger lines are below, well, that's a textbook termination condition. That is a 100% by the book, rules-based termination condition. So guys, give me a yes in the room if you're with me. And this is why we post, so that we can get clarity. If price reaches a divergence high and the trigger lines are below, well, then that is a termination condition, plain and simple, right? And then Walker, I want to go back one talking about the significance of the small chart. The small chart is an entry chart, and that's what I left with when I went on my break there, is the small chart is an entry chart. And do you notice that the small chart, and I love the way he did this, when the rules weren't met on the large chart, the small chart meant absolutely nothing. The small chart didn't even come into play for him. And that is the most effective way to use a small chart. And it doesn't matter what trade you're taking, guys. If the large chart doesn't tell you that it's time to go, the small chart, you don't even have to pull it up. You could literally have this on your screen and only this. And until the rules were met, there's no reason to go to this chart. And then if you need me to expand on that, let me know if there's something specific about the relationship. But it really is. The large chart leads the way, and the small chart's just an opportunity to get into the market based on those advantages. And Gary, I don't know if you're with me in here, but did you catch the little termination condition lesson there? Price reached the area, all the triggers are below, it's 100%, it is textbook termination. That's a spot that may reverse the market. It's not guaranteed to reverse the market, but that's a spot that may do it. The same way this was a spot, right? So termination conditions break every now and then. So if you were looking for the HVA, you'd be looking for those trigger lines to roll. But a pivot stop out, it'll qualify. All right. So PFI says odds favorable. And this is the one we saw everybody look at earlier, and a couple people took. Odds favorable, right? And it pulls back to the mid band. So PFI, let me take a picture. Two divergences don't worry us, right? Two divergences were like, with odds favorable and a clear path, to heck with you, which means that was your entry, right? That's where you should have been in that market. And then your stop, when the reversal bar prints, would have been about right here. Sound about right? Cool. So PFI, this is a trade where you probably would have taken a small loser had you gotten in at the appropriate time, right? But I love that you recognize the three divergences. And you said, even though I missed this one, now I know that my advantage is going away. So it's a great chart read. Awesome job sticking to your rules. And guys, I am always going to throw applause at you when you stick to your rules. All right, Paul. Gaining momentum, divergence, divergence. And you're in at the area. You're welcome, PFI. I like it. It has the potential to go, right? The path is clear. The smalls are trying to break above. It's a pretty good look. These split triggers means that there's a little indecision. So you get in at the top, but without the best momentum. And Paul, typically I see you getting in a little lower without the best momentum. And this is on the S&P. I really think this is one of those ones where it wasn't odds favorable yet, and then you knew that it was a little slower because of this one. This divergence on your range chart probably would have kept me waiting for a signal. Have you ever seen the correlation, Paul? And you guys that trade these 8 range charts that have them up and looking at them, when divergence prints on a range chart, it tends to push lower. So when I see divergence on a range chart, that's usually a pretty good sign for me to just hang out for a second and see if it's going to hit that lower area. And then there's that same look, and it does push lower. And I love it when your next picture says exactly what I just said. Waiting for that signal would have been a great opportunity because of the losing momentum and because it's not your best and because of the split triggers. Wait for that little bit of confirmation there. It's a good look, Paul. All right, Jose trades. Yes, he does. Same one. Just doesn't work, right? This look always gets you. This is a different chart though, isn't it? So Jose, this is the tail end of momentum. We can kind of visually see the tail end of momentum as well. You take it from the bottom of the window and it just doesn't work out. I'd take that trade over and over. There's too many advantages not to, Jose. And I don't know what it is, but the market seems to not like to give you a winner on the first one. And then there's that one on the S&P, PFI. You get in. You're in at 48.75. Where was your stop? Right behind the one-to-ones? So you put a couple ticks on to hide behind it? Nope, 12 ticks. In at 68.75, so 65.75 is your stop. I don't know how it didn't get you then. Woo! And these are the gods smiling on you. Well, 68.75, 12 ticks on the S&P puts you at 65.75. This is where if you're going to hold through all of this, I might put another 2 or 3. That's okay. It saved your bacon and gave you money this time. 10 contracts. How soon we change our plans. Nice trade, PFI. Good hold. That's okay. Sometimes mistakes work out. And then Debbie says, that's not a mistake. Let's get paid. Beautiful, Debbie. Nice job. And Debbie, am I correct in saying that because it's not the absolute strongest, you're pretty good getting behind these one-to-ones with your stop? Yeah. So that was tactical. So PFI, you're just a little smarter than you thought this morning. You are Debbie smart this morning, which is a great place to be. And then there's the same look again. And Snorri, it's an appropriate stop. It's an appropriate stop. And we're seeing both sides of this, right? You're absolutely right. The smalls are breaking above. You're absolutely right. The path is clear. You're absolutely perfect on your entry. And this one just got you. That's it. That's all it is it got you. And you're absolutely right. That's your target. And sometimes the market pushes a little lower. Sometimes the market pushes a little higher. The one thing that gives you an indication that it may is this visual loss of momentum, that divergence. It may push a little bit lower. And Debbie just has the repetitions and the experience to understand that sometimes it's worth to put an extra 3 or 4 ticks to get behind that one-to-one, because these one-to-ones very often collect the overrun from a fib. Does that make sense, everybody? So that's a great lesson, is you're going to see that happen every now and then. All right, E, welcome to the room. Just started the demo last night, but you've been watching videos for a month, and you absolutely nailed it. E, welcome to Nexgen. Are you in here? So you're telling me that just from watching videos and keeping it simple and not overthinking, you can identify momentum, a clear path in an area inside of favorable large triggers to make money? It's simple. You watched one day a month before the demo. So you came in with a foundation. And guys, Nexgen doesn't hide anything from you. When I tell you to keep it simple, guys, this is why. Because simple works, right? Because this works as long as you work it. Eve, fantastic job. Welcome to Nexgen. Thank you for posting on day 1, too. Of course, if you've been watching the videos, you've heard me say at least 30 times, post your pictures, post your pictures. That's outstanding, day 1. I have a feeling we're going to see you for a long time. Stopped out rules met. Oh, that's awesome. You can see what we were doing. And E, I want you to spend the next 10 days on your demo following those rules and trying to prove them wrong. I tell that to all new demos. Try to prove it wrong. Go back and do the study. Because if you put that much into it, you're going to be with me forever. All right. PFI? Nope, it's the same critique I gave the 3 people before you. Smalls are breaking above, the path is clear, the entry's perfect, the stop's appropriate. Do you know what my favorite part about this picture is, PFI? Is your annotation. Because after you noted that you were stopped out, is you wrote rules met, right? The only other thing that you could write on this chart after rules met, Paul used to do this all the time. Next. I'm going to wait for that next setup that gives me an awesome advantage. You don't have to put it there, but Paul used to. And it was so cool because when he really started to learn and trust those rules, that was his magic word. Everything was perfect. All of my rules were met. The entry was spot on. It didn't work. Next. Let's get the next one. All right, Walker. Same trade. Oh, you're looking here. Waited for the pullback, pulled back more, stopped out. Okay, so Walker, great picture, man. I'm going to take a picture of your picture, and we're going to go through a couple different things. Cool? And guys, you newer users, I really want to get into this and revolve around the advantages, and this is great. So you went short right here, and then you got stopped out up here. So there's a few things that we can look at here. The first thing, your small triggers are cranking, right? Your small triggers are down, they're flying, they look good. Do you notice how flat these are? They're trying to turn, but they haven't quite. This is the first thing that I noticed, but that's okay because every trigger line that ends up strong looks like this at some point. So I love the visual. I love the downtrend. I love the small, strong. And this is what got you thinking, man, it's time to look. It's time to look for that pullback. Sound about right? Guys, sometimes I say things that are not your line of thinking. Always correct me. So rule number one, you're like, I've got momentum. I'm in a downtrend. With the adrenaline gone from the trade, Walker, can you tell me what you traded directly into? In the moment, I don't always see it. Guys, when my emotions are running high, so you traded right into a textbook termination condition, right into a fib. So I'm going to show you a couple things that happened here. First, price reaches the area and no triggers break through. And this is exactly the recipe for a termination condition. And this is how you're going to be able to identify these areas that may create a bounce. John told me that there's too much information on these, but I'm going to share these pictures anyway today. So from a low, price reaches the area if the triggers remain above. This has the recipe for the termination condition on it, guys. I love it. I want you guys to have these. And I want you to always go through that in your head. Did price reach an area? And if it did, where are my trigger lines? So those are the ones from a low. Where are my triggers? There we go. There's my termination conditions from a high. These are great pictures, guys, just to put into your spreadsheet. Study in the morning. So what we ran into is we ran into a fib with no triggers through. So this is an area that may create a bounce. It may stop the market. And then Walker, the one thing that you probably don't know about yet is that when price reaches a Fibonacci area or the midband and the large triggers remain a full bar away. So do you see how there was room for a full reversal bar to get back to those large triggers? I'll make that a different color. This is what we call the gap theory. And this is for all of you guys. The gap theory means that if price accelerates away from those large triggers so fast that it creates a gap bigger than a full bar and it hits a Fibonacci area, whether it's fibs or a midband, it's likely to close the gap back to those triggers. So you're going to see it at midbands and you'll be able to gauge it. If your large triggers, if the market accelerates fast down and the large triggers are all the way up here, it's likely to close the gap to those large triggers, if the large triggers are above the reversal bar marker, because the reversal bar marker shows you exactly where that bar will form to the upside. So there's room to make that bar. You'll also see it on fibs when those large triggers don't follow. It typically closes the gap. Same thing over here. The fib is reached and the large triggers are so far away that it just gives you a little, hey, don't take that trade yet. Don't go long just yet. Let's clear that path. Let's close the gap. And I think I have a picture of it actually coming to fruition somewhere, kind of the full tilt. Sorry, guys. I take so many pictures. And this is it right here. And Walker, this looks almost exactly like the chart that you just shared. So this is a fantastic example. This looks almost exactly like your chart, doesn't it? Pulls all the way back to the midband, all the way back to support, and those large triggers are hanging up here. And it just lets you know. If the termination condition doesn't get you, the gap reminds you that this behaves like a vacuum. And when it behaves like a vacuum, any short trades inside of that vacuum typically get sucked up and run over. And then Snorri says, here's one more for the collection. Reaches the midband and the large triggers are a full bar away and it closes the gap. Snorri, that is perfect timing. But that pattern keeps you from looking for a short trade with that red background is what it does. And it behaves a little bit as a safety thing. So then going back to what we were talking about the small chart, Walker, is when the large chart doesn't give you the go-ahead, when the large chart doesn't say, hey, let's go after it, let's do it, don't even worry about the small chart yet. So the termination keeps you from looking for the entry, right? The gap theory keeps you from looking for the entry. And this is how money gets made, guys. Not from taking the perfect trades, but from being able to eliminate these low probability scenarios, eliminating these rules breaking trades. And you've got to break the rules 1,000 times on simulator so that you can understand when it's appropriate to not trade. So this is a great picture. And this is one of those instances where the small chart should have never come into play because the rules weren't met on the large chart. There was a lot of things working against it. Does that make sense? Does that help? I hope it helps. And then guys, Nexgen Ben reminding us that when you come up with the system, there's money to be made. His open equity right there is a little over $22,000 on 15 contracts. His open equity in this trade, little over $15,000 from momentum and a clear path. And guys, I'm going to put his dirty laundry out there. It's Get Paid Friday. Ben started with the software. And Ben didn't embrace the idea that simplicity was good, and Ben didn't have a plan. And just like a lot of us did, Ben spun his wheels a little bit. And then he collected his thoughts and he came back with a very strict plan. And he came back with a very specific plan of attack. And I'm telling you, simplicity pays dividends. Ben, can I ask, how many different trades do you look for during the day in your plan? Two. Two different trades, guys. Pretty awesome. Ben, thank you for being here and for sharing that. Ladies and gentlemen, you have the best software in the world. You have the most high-tech elliptical. But if you don't get on it, it's not going to do you any good. If you don't learn how to use it, it's not going to do you any good. So learn how to use it. Contextual awareness area. Don't get caught up in consolidation. Fibs are everywhere. Thanks, Ben. So I like the contextual awareness picture, right? Weak triggers working their way inside. Do you notice that there's three divergences, and we know that that's a potential termination condition? The smalls are below, support is holding, resistance isn't working. You can see the indecision. What a great decision, guys. Sometimes you're going to be in a better position doing nothing than you are trying to figure out what the market's going to do, right? Wait for those clear paths. Wait for those advantages to be present. Cream, you're killing it. Paul says, from a termination that reverses the market, that gives him odds favorable. This is one of those 50-50 trades where the area has the potential to break, but it hasn't broken. But notice that every one of these charts agrees. You say you're taking it at the bottom of the window, but your bottom of the window, Paul, is 87.52. You're 12 ticks above the bottom of the window. Or maybe 59, because that 1-to-1's falling outside of it, right? From the highest point of the triggers to the lowest point of the triggers, the highest point of support inside of triggers to the lowest point. So 59 represents the bottom of the window there. It's still a great looking trade. And if I see Jerry typing, that means Jerry took it somewhere. So there's that indecision on the S&P. Pushed it all the way down to the mid band, all the way down to support, and those large triggers are hovering above. And then there's crude oil. And they just haven't gotten you yet, right, Paul? Jerry, I try to make $250 a contract. That's it. Because the reality is, if I could make $250 a contract, I'm good. If it's a great day, I'll keep trading. Like if it's just giving money, I'll keep trading. Um, but my minimum goal is I want to make at least $250 a contract. So I put myself in a position to make that as easy as possible. And guys, let me show you why. If I'm trading a two lot and I make $250 a contract, that's $500, right? That's only two contracts. That's $2,500 a week. That's 10 grand a month from a simple $250 a contract. Now what happens if that 4 lot becomes a 10 lot? Then I just made 50 grand that month, right? And what happens when that 10 lot becomes a 15 lot, and that 15 lot becomes a 20 lot, and that 20 lot gets multiplied on 20 accounts? Ben, I was going to yours right there. So let me show you guys something real quick. This is the part that you don't see on Ben's chart. Ben's chart says 15 or 22,500. 22,455, right? What Ben does is he runs 20 accounts that mirror that behind it. So what you don't see is that's Ben's trade. And I'm not going to lie, Ben, that's pretty kick-ass. How many $450,000 trades do you need until you can retire? But it's the same trade. And guys, this is not normal, right? It's not always a huge runner like this. It's not always a huge runner like this. But every now and then they do. So it's not about more trades. Ben only takes 2 trades, guys. It's about the best trades. Take the best trades to get paid. That was your last one, PFI. Wasn't it? Ben's, you can't tell anything from Ben's chart other than he made a lot of money. He followed his rules and he made a lot of money. Make your own rules and crush it. Amen. Gary, everything says down. It pulls all the way back to the mid band. You say that short didn't work. So right here at the mid band, I have resistance. And you get out a little early, but it still works out. And guys, this is a dangerous habit to get into. This is Gary's exit, right? And we know that because we saw his exit on the last chart. There's my exit. At this point, guys, it doesn't matter what happens. Once you make the decision to exit a trade, it doesn't matter what happens. And Gary, this isn't just for you, this is for everybody. If you start taking pictures of what you didn't get, if you start taking pictures of the money that wasn't yours, you're going to start making decisions because you feel like the market owes you that money that you didn't get. Typically, human nature. Once you make the decision to exit a trade, that trade is done and it doesn't matter. Doesn't matter what happens next, guys. Your job is to wait for the next trade. That's it. Wait for the next trade. But this right here, this is remorse. This is you deciding that the market owes you another $600 and you're going to go chase it, right? Not you specifically, Gary. This is just, it happens to be your picture. I try to never assume what you guys are thinking. I can usually tell what you're thinking because I've done this long enough. But I've seen this a lot. I see the market run and I see people just say things like, oh, there wasn't an entry. And since there wasn't an entry, I'm mad as hell about it and I'm going to make one up. Smalls are through, large are not, no divergence, strong triggers. There's your area inside of favorable large triggers. It's already given you a reversal bar. Should you decide that that's your trade? NASDAQ screaming up, odds favorable momentum. That's a pretty big window. Maybe it's your trade. Maybe it's your not. Maybe it's not. Right into one-to-ones, even with odds favorable momentum. Right into one-to-ones. You guys see that on the S&P? So guys, this is one bar tells the story. One bar tells the story. One bar says, don't go short. Snorri says, is this a weak top? If you ask me, and I love that, if you ask me, I would say yes, since the triggers have cleared the area and the turn is kind of from nowhere. Snorri, I would say that you're a fantastic student because you remembered the recipe, right? What's the recipe for a strong top or bottom? It's a termination condition that creates a full reversal. And it really is that simple, isn't it? In order to have a termination condition, price has to reach an area. So Snorri, picture perfect. That picture's coming from nowhere. It didn't reach the area. And even more so, there's all of that support, and those large triggers are up by the reversal bar. Great read, Snorri. And then Ben, it looks like you took a trade from support, a pivot stop out at support, and your large chart probably said the market's likely to go up. So you went up. You know that my curiosity brain, hold up, where was your timestamp? 9:13. Okay. Are you Eastern time? Let's look at it. What did the large chart look like at 9:13 a.m.? At 9:13 a.m., price pulled back to a midband. Large triggers absolutely refuse to follow. That's the gap theory. Is everybody comfortable with that? Ben, what a great predecessor to a fantastic trade. An area that is likely to stop the market and create a bounce the other direction. So I like that. You're fighting the trend, right? But it sure feels like a calculated fight based on patterns that repeat themselves every day. And then, bum, 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 there's a giant blue fib there. And then there's 1, 2, 3 divergences with a higher divergence. Guys, Discord just kicked me out. I'm on my way. Sit tight, guys. I'm coming. Here I come. So what's cool is we're going to break this down to advantages, right? We're going to break it down to advantages. And when we break it down to advantages, we can really kind of piece it together. Let me get a screen. All right. Am I back? You guys can see it? So the first thing is price accelerates away from the triggers really, really fast, and the large triggers remain a full bar away. Guys, that's your gap theory. On its own, it's not really a trade. The second thing is that acceleration happens to a fib, and Ben didn't go long here or here or here. Ben says 3 divergences in the same location may terminate the trend. Gene, not a picture. Guys, can you see my chart? Gene, still no picture? You may need to reboot. Not yet. Here, I'm going to turn it off and turn it back on, guys. Hold on. I don't want Gene to get left out because this is some good stuff. Is that better, Gene? That was a little reboot on my end. If not, then it's going to be on your end, and you may want to reboot. But hopefully that got you. Okay. So Walker, this goes back to the large chart leads the way. Large chart pulls back to a mid-band. Large chart's not coming from a termination conditions. Large chart triggers didn't follow, letting Ben know that it's at least likely to close the gap. He's not sure if it's going to go 10 ticks above, 10 ticks below. Is it going to be the mid-band? Is it going to be the one-to-ones? At this point, he's not sure. His small chart gives him 3 divergences in the same location, guys. And if we go to the user guide, that tutorial section, and we go to termination conditions, 3 divergences in the same location may terminate the trend. And that becomes even more powerful when the third termination has weak triggers, and more powerful still when the third divergence, is higher than the previous. So if we look at Ben's picture, there's 3 divergences in the same location. Not only that, but there's 3 divergences with a higher pivot. And the large triggers have rolled, and all of this is confirming that this is the spot where it's likely to stop. So Ben takes an entry with 15 contracts. And Ben, I'm not going to presume to understand exactly what goes on in your head, but I would wager to say that at all of these areas, he was making sure that things stayed good because he recognizes Fibonacci and it could create a problem. But he noticed that his momentum's increasing, right? And if we scroll over, his small chart never blinks. Never blinks. So Ben is like, well, shoot, I'm going to ride this one out. And I would be willing to say that at this area right here, once again, Ben said, let's look for a reaction, and he didn't get one, so he stayed in the trade. And at the next potential problem, Ben says, I'm going to wait for a reaction. And I would wager to say that at this fib area with 3 divergences, Ben, was that possibly an exit? I didn't look at your exit for the one that you posted for PFI. Shit. Ben said, I'm not even waiting for it. I hit a fib, and now it blinked. It's not in the divergences, PFI. It's not in the divergences at all. If the large chart didn't say go, Ben would have never gone. Ben's not going to let divergences talk him into a trade that isn't supported by a large chart. That's the important part. So what you just did is fixated on the small chart. The large chart said the market's likely to continue up. The small chart helped him pinpoint a spot. That's all it is. And look at this. There's the first blink at an area, not coming from space. And there's the exit. Ben, I love everything about this trade, man. And I like that I'm able to go back and use chart reading to determine exactly what you did. It's not my trade. It's not in my plan. It's not a trade that I take. But holy smokes, I can appreciate every bit of chart reading that went into it. And guys, give me a why in the room if you see how I dissected that, letting the large chart lead the way. And then using the small chart for an entry. But all I used were those concepts of chart reading. All I used were clear paths, were areas likely to hold, right? Remember that Ben's 8 years ahead of you. 8 years ahead of you. Debbie, have an amazing weekend. When I make it to Texas, I'm going to come up and meet you. Areas likely to get paid. I love it. And guys, the challenge that a lot of users are going to have, is you're going to try to take Ben trades. You don't need 8 years. Snorri, I'm telling you right now, if you stick to the plan, you don't need 8 years. The one thing that lengthens the learning process is fighting simplicity. The one thing that makes it harder to get consistent is giving yourself too many things to be consistent at. That's time tested. Fighting the triggers. Just go with the flow, right? All right, E, second trade. Smalls above. The large haven't quite made it through the area. You take your entry. And this one gets you, huh? So I'm going to ask you, E, are you comfortable with the idea of the 50-50 trade, of areas that aren't quite broken yet? So let me show you the three scenarios. I'm not going to say anyone's better or worse, but let me show you which scenario you're in when we talk about clear paths. None of the triggers through means we're just waiting. We're waiting for the area to break. Both small and the large, E, that's when your path is 100% clear. That's when there's nothing in your way. That's when the advantage of a clear path is present. So what you kind of got caught in here is the smalls had broken through with that odds favorable momentum, but the large hadn't quite made it. And this is what we refer to as a 50-50 look. And it just means 50% of your triggers are through the area, but 50% are not. This is an area with the momentum that has the potential to break, but it hasn't yet broken. And I think that's the key part of the phrase right there, is it just hasn't broken yet. We don't know for sure if 69.80 is going to break, but with this momentum, it certainly has the potential. Guys, everybody give me a why if you're with me so far. This is the first step in looking for trades at this areas is understanding, well, there's two sides to that. If this area has the potential to break, right, but it's not broken, if the path isn't clear, let me go through my line of thinking. I revolve everything around, I relate everything back to the three advantages, E. Momentum, a clear path, and an entry area. So if I'm forfeiting the clear path because the area hasn't broken, what I'm going to do for my own personal is I'm going to make sure that the momentum is amazing, and I'm also going to make sure that my entry area is really solid. So on these 50-50 style trades, here's a picture of one. When the smalls break through but the large haven't, as a brand new user, right, as somebody that's still learning to read their charts, it's okay to expect the perfect entry. It's okay to demand that there's no divergence, because a divergence is a loss of momentum. And if you just go back to the advantages, the path already isn't clear. Do we want to forfeit momentum and still trade what becomes a medium probability trade, right? So maybe not a little more generous with the stop, but a little more stingy on what I'm willing to risk. So I'm going to make sure that I have strong triggers. I'm going to make sure that I'm not giving away momentum through divergence. And I have the preference of a tight little small window of opportunity, the least amount of risk possible, as I hope that this area breaks. Does that make sense? So yours, no divergence, beautiful entry. I love it. Everything about it. That's about the most conservative way that you can take this medium probability trade. But when this divergence prints, now you're losing momentum and the path isn't clear. So for a lot of folks, this becomes an exit condition when the divergence is true, which might have gotten you out closer to break even. You know that the area is not broken, and now the momentum's going away. Notice how the small triggers are on the wrong side of the large. Visually, you can see that that momentum is kind of kicking the bucket. Does that make sense? So if the momentum is kind of going sideways, yeah, then you're compounding the problems and you're losing advantages. Yeah, it's okay to exit a trade. You don't have to be married to it forever. As you're on simulator doing things, it's okay. Stay married forever. Drop it in class, and we'll talk about everything. Um, and then every day in class, I give out this KISS trading plan. Whoops, that's the wrong one. Sorry. Um, so this KISS trading plan, the Keep It Simple plan, has that 50-50 trade in here. And this is not the end all be all to take a 50-50 trade, guys, but this is really the most conservative way to take it. So as you're learning to read your charts, this is the way that requires the least amount of management because the likelihood of victory goes up compared to when one of these problems are there. And it all begins with that odds favorable momentum, and you nailed it. And the smalls outside of diverge outside of the large on the 5-1, and you nailed it. No divergence on the 5-1. You nailed it. From a good top or bottom. Nailed it. And then because divergence is such a problem on these trades, I even put it in there extra. Divergence, no trade, right? So you nailed 100% everything that we look for in that 50-50 trade. Are you with me so far? And watch this. So one of the things that I like to do, if you guys have Snagit, is it's all right to take a picture of your rules and then just paste them right onto your chart. Um, so if I take your picture and blow it up a little bit, and I take a picture of your picture, this is a great way to get comfortable with what you're looking at and what you're doing. So I'm going to take your picture and I'm going to add that checklist. Just go to techsmith.com. There's TechSmith right there. It's $63. Guys, all it is it's the capture software with more bells and whistles. That's what I use every day. For me, it's worth the investment because I do this for a living. And I do a lot of chart annotating. So E, on this one, you marked yes on every one of these, right? And your entrance, it's rock star. It's amazing. And then the second half is when you take these medium probability trades is we have to manage them. So management, because you're forfeiting some advantages, is a little different. Your initial stop is still outside of the window. You still use the reversal bar, but now if divergence prints, you exit the trade. You say to yourself the conditions are changing, it's medium probability, the area isn't broken, and the momentum's going away, and I'll just exit. And that becomes kind of your management approach on those medium probability trades. Does that help? Does that make sense? The entry was outstanding. And entry is only the first piece of the puzzle, guys. Every great entry creates a manageable trade. Every entry gives you an opportunity to make money or to minimize your losses through an understanding and through chart reading. So great job on that one. And then Snorri, you posted something in there. Hold on, let me find it. I just saw it. Maybe I didn't. All right. Two tails touching 1-to-1 on the 13-2. Now waiting for strong triggers and a clear path. Also aware of magenta, aware of the fibs. I love it. Dwight, you have simplified your process considerably. You know that we're at a termination. It has the potential for a reversal, and you're saying, I'm just going to let it set up and look for the long. Great job. Great read. All right, and then Ben says, if you follow the Novak Next-Gen plan, it's the Next-Gen plan. You will find your trade from experience. Ben tried to reinvent the wheel and wasted years. The class and the software putting in the time works. It's not just kissing up here. He doesn't work for Next-Gen. And Ben, we're forever grateful to have you, and you are part of the family, guys, and we are a family here. There's a lot of Novaks in this room, and everything that we teach, we use, right? So we're not just doing this. We're not just selling cars that we don't drive. Like this is it. Provide a quick macro understanding of the concept of divergence. Absolutely. Let me click on Snorri's picture real quick, and then I'll get to that question, Chris L, and we'll talk about it. If the small triggers have cleared the area and 1 out of 2 large triggers have also cleared, is that still a 50-50? And does it still have more odds that the area will clear if only one large is missing? Great question, Snorri. What's the one thing that's not happening here, though? That odds favorable momentum, right? Strong triggers break areas. I love the look. The further through the triggers are, the more likely it is to break. That's absolutely true story. And don't leave out the momentum. So without a doubt, but it's not broken, and that's really what you want to recognize. And very often, people take these 50-50 trades. Let me see if I can find an example in the moment. People take these 50-50 trades and they let it start to eke out, and they're like, oh, it just barely went. I can't wait to take that trade. But when it really smashes, right? When it really has that big crush through the area, the market's more likely to continue. So right here, this was a 50-50, right? But look at how much of the large had already broken through, and that may be the same picture, just with a little more momentum. So the better the momentum and the further through it is, absolutely, the more likely that area is to break. Did that answer it? Guys, are the client pictures blurry for everybody or just Jim H? They're pretty clear on my end. Um, Jim, let me try something. Let me see if I can adjust my settings to make it easier for your eyes. Um, Let me drop it down one. They're always a little bit blurry. I don't know why that is. How is that, Jim? I just adjusted my settings a little bit. Is that a little more clear? I hope. And guys, always tell me if this happens. I'll do everything I can. If you pop it out, it's better. If you use the pop out for the room. And after I rebooted, it was more clear. Okay, I dropped not everybody has the same high definition monitors that I do. So if I'm looking at a high definition on my end, yours may not be able to keep up. So I dropped it down. Hopefully that helps a little bit. All right, Chris L, are you an engineer? I'm going to ask. Nope. Okay, good. Then you'll probably accept my answer. Um, and Chris, I know that you're new here. And guys, this is my disclaimer for everybody new here. I am very much not a tech guy. I was an English lit major. I get paid to draw outside of Nexgen. Um, why is the E-mini different than the full ES, Cream White? Is that what you're asking me? Why is the micro different? So Cream White, why is a Corvette different than a Camaro? Because they're different cars, right? These are different markets. They're both derived from the S&P 500, but they're completely different markets. Thank you, Snorri. So your micro ES may move a little different. Your ticks may be a little bit off. It's totally normal, but it happens because they're in fact different markets. It would be like if you had crude oil and natural gas, right? They're similar, but they're going to work independently. That's a great question because a lot of people ask that. And if you're trading the micro, Dwight, um, you can set up your S&P, and the large S&P is always going to lead the way. The large S&P is the one that's being moved by the big pockets. But you can take that large S&P and your large chart and use all of those great areas and use all of that momentum and everything. And then you can look for opportunities to enter on the micro S&P. I always leave this one up so I can show you. And because I get an inactivity fee on NinjaTrader 7 if I don't take at least one trade a day, or not a day, a month. So today was my day. Today I made a quick $10 for my account. just to keep the data going without that $30 fee. So running a big ES with a micro ES. So look how similar they are, but they might be a tick or two off because they are in fact different markets. All right, Chris, here we go. So I'm going to go to the glossary of common terms, and I'm going to do it the way my brain works first. Divergence is a loss of momentum. Nothing more, nothing less. Divergence is a loss of momentum, which means, let me find where divergence prints. So the easiest way to understand it, and you can do it on a large chart, on a small chart, it means the same thing everywhere. This cyan line printing, it doesn't happen until about right here on this third bar. This cyan line printing doesn't happen until about this third bar. But all it means is that if it prints, if that negative number prints, and the negative number is inconsequential, it doesn't mean anything. It's not, there's not different degrees of divergence. If it prints, it meant that price pushed all the way down to form this pivot. And then the second thing that happened, and we'll use a yellow arrow to represent momentum, momentum didn't follow. And that for me is the easiest way to understand what divergence means. So the market came down and then it pushed up, but that momentum wasn't able to follow, and that's what gave us this divergence. So it gave me a visual indicator that the market is losing momentum as it tries to push down. And this is a great picture because look how it works here. Coming off of a termination condition into a key Fibonacci area, we knew that this was a reaction point, right? The buyers just, this is our area, boom. That's why we don't go short. But when it hits this resistance, the sellers aren't done. They're going to push back. It always happens, right? But the buyers said, we already reached our area. We want the market to go up, and they rob them of their momentum and continue up. And you can see that visually through this line. Does that make sense? So that's the remedial. That's the my artsy fartsy brain understands divergence. And what it is for you technical guys, and you guys used to have to do this on your own back in the day. If you started Nexgen 10 years ago, you had to do these calculations yourself. Now your software does it for you. And Chris, it uses what's called a MACD. And this is a momentum indicator. And then it compares the swings in the large chart to the swings on the MACD, and that divergence between the two, that discrepancy between the two when momentum doesn't follow price. Here you can see that price pushed down, and the MACDs didn't retrace very much. That's your divergence indicator, but Nexgen has written it in so you don't have to do any calculations at all, which just makes your life a little easier. And then we'll use it. Let me show you how we use divergence here in the classroom or here in your real world trading. Divergence lines can be termination conditions. You're like, man, I didn't want this much. I'm going to get it anyway because I'm on a roll. So when we talk about those termination conditions, those areas that may reverse the market, Fibonacci support and resistance, these are a culmination of areas. These are thousands of calculations coming together to create these blue and red areas that act as support and resistance. These divergence low lines and these magenta high lines, these are lines in the sand. These are exact prices where that market turned. So we can use these, Chris, as areas where either the buyers or the sellers have said, I dare you to come back to this area because if you do, I'm going to unload on you. I've already stolen your momentum once, and I'm going to beat the ever-living snot out of you if you try to fight me. So these are very exact, like a line in the sand. So we can use them as termination conditions, and we can use that recipe. If price reaches it, but the triggers don't break it, you'll see very often that the market will in fact retest these divergence lines. And when the trigger lines remain above, well, now we call that a pivot stop out. So divergence lines give us that pivot stop out. And it means that the buyers stole their momentum. And when they came back to it, the buyer said, you know what? game over, brother. And they push really, really hard. So that's what divergence is. It's a loss of momentum. And that retesting of divergence without the triggers going through, that's what's going to create that advantage of understanding where that market may reverse. And if you scroll back, there's a beautiful example of it. And look how long it took before the market came back. And there's that official pivot stop out. There's one here that pushes up, and then it pushes really back. And in this consolidated market, you see them fighting those lines over and over. And look how that one tick past that low, and it creates that push up, and you get the same thing from the bottom here. All the trigger lines remain above. So I hope that answered your question without confusing you. Um, and I always keep it in my brain as remedial as possible. It's a loss of momentum. And hopefully that helped all you guys that are curious about it. John Novak always makes the joke that momentum or divergence is like pregnancy. It either is or it is not. There aren't different degrees of divergence. There isn't really super divergence and minor divergence, right? You're either pregnant or you're not. That's it. There's either one in the oven or there isn't. But that's how we use it. So awesome question. There's one of those pivot stop outs right there live on crude oil. And look at the reaction of the market. The buyers took over, stole the seller's momentum, shoved it all the way up to that next key area. The small triggers broke it, but the large didn't. There's that 50-50 look at 1050. There was one shot at getting in, and that divergence said get out. But the buyers weren't done. All the triggers were above the key area, and they got right back up to divergence one more time. And that's where the sellers appear to be trying to unload on them. But they've got to get through that 65 area, right? They've got to get through that key area that all of you guys knew about. When price reached it and the triggers remained above, you know better than to go short because you don't have a clear path. Whew. That's a chart read, guys. 90% of your day is reading charts. 90% of your day is understanding that when price reaches a Fibonacci area and none of the triggers break, you have to be patient. That strong triggers have the potential to break areas, right? That when everything is above resistance, it behaves as support. How many examples can we see in one chart, right? So your job is every time you open a chart, guys, every time you get to your workspace, start the process of going through what it is that you're looking for a trade, right? And how do you do that? You do that with your high probability trend trade checklist out on your desk. Where is the market coming from? Is it coming from a good top or a good bottom? And here's your homework for the weekend, guys. I'm going to give you a video watch list. And the first video on this list is going to make you amazing at tops and bottoms for those of you that are brand new. It's John Novak going through everything he's taught for 20 years to help you understand how powerful Fibonacci can be, how to recognize when it may reverse the market, and also how to recognize when it has the potential to break. And then you've done that, so now you're going to ask yourself, do I have that odds favorable momentum? And if the answer is no, convincing yourself that it's time to not look for a trade anymore. I don't have the momentum. I'm brand new. I'm trying to have every advantage. Therefore, I'm no longer looking for a trade. I'm going to wait until I have it. But if you do have it, then you're going to go through that process. Well, do I have a clear path? Am I above the areas that had the potential to hold? And have I not reached the areas that have the potential to stop the market? And if you're answering yes on these three, Walker goes back to your question earlier, then and only then is it time to go to your small chart. Then it's time to refine that broad stroke of a brush, to whittle it down to the point where the market is likely to continue, and to take that kick-ass entry, that entry that creates manageable trades. So one bite at a time, guys. Don't be in a rush to be this super trader. Understand your trend, ask yourself about it, and if you have it, make sure that you're trading with it and with the momentum. And then make sure that there's nothing in your way, and then worry about your entry after the first three are taken care of. And if you embrace this idea for 30 days, it's going to change your world, guys. Going to change your world. Don't be in a hurry to make the money. Be in a hurry to master the process. The money is a byproduct of the process, guys. The process yields results. It's not the other way around. Your desire to be rich will have very little influence on your ability to get rich. Your desire to follow a plan that provides a statistical advantage every time you enter the market is the key to your success. I know this because I've been on the same path that you're on. I've been on the same path that you're on. I've made all the mistakes that you're going to make, and I teach this class from the point that I don't want you to screw everything up the way I did because you don't have to. And you've got to be patient with the process. Everybody gets there at a different time, right? Everybody gets there at a different time. This has been a fun class today. I hope you guys are learning stuff. John and I wrote this one Sunday morning on Skype together, drinking coffee, doing market replay. We're like, how do we convince these guys to stick to the path? And well, how do we say it so they understand it? To minimize your learning curve, post pictures of your trades in class. Every trade, win, lose, or draw. A lot of you are going to be scared to post losers because you have been taught in life that losing means that you failed. Losing does not mean that you failed. Losing means that you've created an opportunity to be better the next time the situation presents itself, right? If you win and the rules are wrong, you may have a short-term victory, but long-term failure. How are you going to know the difference if you're not comfortable reading your charts, guys? You need feedback from us. We're here to help. I love my job. I hope that it's evident in the way I teach the class, but I absolutely love teaching this class. I love helping you guys grow. If you place a trade on simulator and you participate in class, there's no risk or loss of capital. You can't blow out your kid's college fund on simulator, guys. You can't piss off your wife because she's not getting the new car if you keep your education process on simulator. So you need someone to tell you what you did right or wrong. You need me to look at your charts and to give you feedback on everything that you're doing. And guys, I don't have a personal attachment to it. I'm looking at it objectively, but I'm looking at it from a rules-based standpoint. I'm looking at it from the point of advantages, and I'm looking at it with the goal of making you better, right? I don't get paid for you to become a successful trader. I don't get paid if you make $1 million. I get paid my salary to teach you how to read charts, and that's what I love doing, guys. You need to understand the challenges that you're facing and how to overcome them, and that's what the class does, and that's the magic in Nexgen. Um, yeah, you can. So you changed the ticker symbol in 8 and something went wrong? What went wrong, Dwight? There may be an easy fix. It was around. What do you what are you trying to accomplish? Maybe that'll help. But yeah, you can change while in simulator. It's okay. You can change it mid-stroke. It's no problem at all, Dwight. It'll just take a minute to recalculate and go through, and especially if you don't have the historical data for the MES, it's going to take it a minute to download everything. So be patient. Um, you can also, if you want, what opportunities are you going to catch on the micro charts that you can't catch on the big charts? That's my question. Guys, micros seem like a neat thing to do. The micro S&P is 125 a tick. Your commissions on a micro trade are about $3 around turn. Um, Go through the education process. Use those large charts that move smooth if you want. And then, Dwight, when you think it's time to test your plan, Apex is a great way to do it. And there's still really no huge fear of loss. For $35 a month, you can control $50,000. You can trade that large chart. Um, but if you want to do micro, just Build a workspace. Build you a micro workspace. So write in the instructions, where's building charts? Build new charts. Right there. This is going to give you everything that you need. There's no reason to ever lose your own money anymore, guys. None whatsoever. All right, Snorri. The weak top was what you were talking about, right? So we know that it didn't come from a termination. It wasn't a key area where those big wigs react. And then it comes all the way down to support, mid-band support. In John's video, he talks about tops and bottoms. Bad tops and bottoms love to make it to the next fib. It's not guaranteed, but what you're watching right now, Snorri, it is fascinating. Because check it out. There's your bad top, pulls all the way to support, makes it to the next key area. There's a pivot from space, hits the mid-band, makes it to the next key area. Over and over. This one extends the area a little bit, pulls back to the mid-band and support, goes to the next area. There's that bad bottom to the mid-band, back down to the key area. Guys, patterns repeat themselves over and over. And look at this one. This bad top came all the way to support, and then your fib update told you exactly what you saw. It was a key area. Snorri, awesome job reading these indicators. But these are the patterns that repeat themselves every day. There's that consolidation between support and resistance, not getting caught up in it. There's that bad bottom again, all the way to mid-band and resistance. Look at that perfect termination, and there's finishing the move to the next key area. Snorri, great job picking up on that pattern. Guys, these patterns repeat themselves all the time. If you take this weekend on a large chart, look at how many times termination conditions hold. Look at how many times bad tops or bottoms go to the mid-band and then finish the move. You're going to be absolutely floored. And then take pictures of it. And Snorri, all of these great pictures that you're taking should go into your chart reading section. Solid work. All right, E, termination, full reversal. We're in that 50-50 look. Beautiful read. And from that 50-50 look, divergence prints, and you're just going to wait and see what happens. So you've decided that you're going to err on the side of caution, right? I like it. And then E, I'm going to go ahead and tell you right now that in a month's time, you're going to start to recognize that with this termination condition, it's going to add fuel to the likelihood of this winning. With this coming from a bad top over here, it's going to add fuel to the likelihood of that 50-50 winning. And you'll begin to incorporate these patterns that will change your rules. Your rules will be ever changing as your ability to read charts is ever changing. One thing though is you don't have your synthetics on. So we're trading into resistance right here. So that divergence is probably keeping you pretty safe. Good stuff, guys. Whew, I'm spent. How was your week? Those of you that started with me on Monday, how do you feel on Friday? Those of you that started with me last week, how do you feel this week? Is it a noticeable move forward in your education process? Ben, you feel richer? You feel better, Joel? I like it. Joel, your consistency has been amazing. One of the things a lot of people don't do, guys, is they stop and they forget to celebrate the victories. They forget to remind themselves where they were and where they are. I try to never let you forget that. I'm seeing amazing progress in a lot of you guys. So keep it going, but don't let me be the only one that recognizes it. Make sure that you pat yourself on the back. Last week, I wouldn't have caught that divergence on a 50-50, right? You feel like you know enough to get yourself in trouble, chef. Wait till you're a month in. And guys, remember, your brain's gonna try to trick you to leaving your rules and going to your reads, to trading reads instead of rules. Um, Guys, best software on the planet. John Novak will tell you, and sincerely, he'll tell you, if you find something better, let him know. He'll buy it. He really will. Um, but there's no doubt in my mind. Oh my gosh, Joel, he's abusive to me. Don't leave your rules, guys. Your rules are designed to create an advantage. Your rules are designed to give you an edge every time you enter the market. So every time you change your rules, you change the percentage for that advantage, the likelihood of success. So I say the same thing over and over. I told my wife I was going to get a tattoo of a broken record because that's what I am. I'm a broken record. Maybe I'll get that. Maybe I'll do that today. I'll show you guys a new tattoo on Monday. Maybe not, though. I got tattooed 2 days ago, so I should probably let that heal. Um, Termination for the win. Check yourself about being patient. You guys know what I do? Do you know what I do every day? And you guys don't understand this. And let me see, maybe I can take a picture and post it. Every day almost, I trade. I write down on a piece of paper. Every day, I reiterate what it is that I'm looking for. And I take these pictures every day. I don't take pictures, but I write these down every day. So I'm gonna bug my brother. I just took a bunch of pictures and I'm gonna send them to his Skype so I can steal them for the room. And he's gonna be like, "Why are you sending me all these pictures?" And I'll be like, "Shut up, brother," because that's what we do with our siblings, right? We tell them to shut up. So I'm gonna show you guys what I do every day, and this is like just a couple pages. And I know that John's like, "What are you doing, man?" So I'm gonna save them all. Hold on, here we go. Almost there, guys. But I'm showing you guys these because this is how important my rules are to me. And what I found is that even though I'm pretty good at reading charts, guys, I'm writing my rules out every morning. Every morning I'm reminding myself what it's going to take to get me into a trade, what it's going to take to get me focused on what I'm doing. And this isn't my trading plan. These are the little things that I want to talk about to myself every day, every time I take a trade. Making sure I have a clear path, right? Making sure that there aren't termination conditions. All the same things that I talk to you about. When I talk about the synthetics, the red line that just rejected that termination condition, um, so your large chart holds areas from three different time frames. Your large chart I'm looking for the picture too so I can show you. Your large chart will contain Fibonacci areas from the 5-1, which is the skinny one that doesn't go to the end, from the 21-3, which is an even higher time frame. It'll register as a fat one that doesn't go all the way to the end, and then your native fib from the 13-2. So on NinjaTrader 8, in order to get these synthetic fibs, you have to make sure that tick data is turned on. I don't have NinjaTrader 8 up right now, but what you're going to do on your large chart is you're going to right click. And when you right click and go to data series on NinjaTrader 8, there's going to be a little button that says tick data. You want to make sure that that's put in there. But see how this line from my 5-1 shows up right here? So we respect that line. You have it. You could try right clicking, going to templates, and reload that 13.2 Rinko 2023 and see if that changes it. And then also every morning, I'm not sure if this is day one, first day with the software. Every morning there's a little process to go through to make sure that you have the best of the best data. And that's the NinjaTrader 8 best practices. And that'll help you. And of course, Jason's in tech too if we ever have problems with that. And then Alan. Nexgen's momentum trade rules. No triggers through termination condition, down bar, pull back to the mid band inside of really fast small triggers, get out at the trouble spot. Alan, 100% picture perfect rock star. Nice job, man. Gary, termination right here. That termination creates a bounce all the way to the large triggers, and then it continues down. So Gary, what you're doing is if you decide to take this short, you have to anticipate a pullback to the gap. So great read. The fact that you didn't take it puts you in an advantageous position. It just didn't do what it sometimes does. Great job. Good read, great patience. Odds favorable momentum, large and smalls break resistance or support, right? That gives you the clear path. So this is redundant, PFI. I like it. Entry at pullback to favorable large triggers, 10-20, stay in with odds favorable momentum, get out. That's an easy plan, isn't it? That's not too terribly much to think about. And that's your management plan too. And check this out. Let's do this. Let's put that one where it belongs. How do you like that? So you have odds favorable momentum, and then you're going to check for that clear path. They're not necessarily the same. Beautiful. Nice job. Great job refining that down and making it simple. Simplicity wins. Guys, that's it for me this week. I'm going to go look for some high probability trend trades. I'm going to see if Friday afternoon offers anything. I do believe John Novak is going to be opening up the trading room. So if you are an owner and possibly a lease, I'm not sure about the lease, but I think so. John Novak will be over in the live trading room looking for high probability trend trades, talking through the process live. He will not be telling you to enter the market. He'll be talking about why he's doing what he's doing. He did it yesterday and it was rad. He was like 3 for 3. And it's cool is that it's just the same stuff that we talk about in here every day. It's those same rules. GWC, if he does it, he'll be doing it in the near future. I'm pretty sure that he was going to do it, but if you go to the main Discord page, and it may not let me right now, but if you go to the main Discord page, there's a live trading room, and I can't get over there now because I'm running this one. And there's the chat box. Everything is there. You can go through, and you'll see. It'll say that it's live and running if he's in there. I think he's going to do it, but if he does, it'll probably be in the next 20-30 minutes. He'll probably post it in the main room that he's going. That's what he did yesterday. So, guys, enjoy your weekend. I'm going to fly into Sacramento tomorrow morning and go see my nephew get married. Should be a good time. But we'll be back and we'll do it again next week, guys. We're going to do the same thing that we do every stinking day. Can you guys hear me? Whoops. Can you guys still hear me? Because I went to that other link, it shut me down, I thought. Sorry. Rinse and repeat, guys. We're going to do the same thing every day. Broken record every day. Just a reminder, my email works, guys. If you need help, reach out. But I'm going to encourage you. And I'm going to let you know ahead of time that if you refuse to post in class, I'm not going to give you private sessions on the sidelines, right? 15 hours every week, I'm here to give you live feedback. Take advantage of it. Welcome new people. Study over the weekend. Go to that list of videos. Check it out. And I'll be back Monday morning. We're going to talk about it again. Thank you, everybody, for an outstanding week. I'll get this video posted on YouTube in the next 20, 30 minutes, guys. Be good, everybody. Take care.